Hello friends, welcome to Navkar Digital Institute. I am CA VATSAL SHAH. Welcome to this marathon revision of the accounting standard. And in this particular topic, I am starting with the accounting standard. I will cover all the accounting standards of the group 1 and also the introduction portion. Clear? So without wasting much time, let's start with our revision. And then my first topic is nothing but introduction of accounting standard. Friends, whenever I am using the word, the introduction of accounting standard, friends, you should understand that accounting standard is applicable to all the entities or accounting standard is applicable to some specific entities only. And why there is a need of this particular accounting standard? Friends, first of all, if I discuss the objectives of accounting standard, friends, please understand, accounting standard is actually standardize the different accounting policy. Before accounting standard 2, if we discuss where we are having the various accounting policies for the valuation of inventory like FIFO, LIFO and the weighted average. But can I say after introduction of the accounting standard 2, they have standardized the policy and now only we are having the two methods. Number 1 is nothing but the FIFO and the number 2 is nothing but the weighted average. First of all, under accounting standard 7 construction contract, friends, we are having the two methods. Number 1, that is nothing but the completed contract method, and the number 2 is nothing but the percentage completion method. But after introduction of this particular accounting standard 7, now we are having only one method, that is nothing but the percentage completion method. So if you ask me, accounting standard is actually standardized the different accounting policy. Second thing, if you are following the accounting standards, we can easily compare your financial statement. And whenever I am using the word the comparison of financial statement, please understand that we can compare our financial statement of the current year with the financial statement of the previous year, or we can compare the financial statement of our company for the particular year with the financial statement of our competitor for that particular year. Clear? And the third, if I am giving you a two financial statement, one entity has applied all the accounting standards and the second entity has not applied accounting standard. Which financial statement is a more reliable for you? 110%. A company who is following all the accounting standards is a more reliable for you. Clear? So if anyone asks you what are the objectives of accounting standard, there are three objectives. Number 1, standardize the different accounting policy. Second, eliminate the comparability of the financial statement. And the number 3, that is nothing but the reliability of the financial statement. Friends, this is in India. If anything is a mandatory, then people will follow. If something is not mandatory, 110% I can tell you, people will not follow this particular accounting standard. Clear? So basic preparation and presentation of financial statement is basically responsibility of management. But yes, friends, as per section 133 of Companies Act 2013, every company has to follow the accounting standard notified by the central government. So one thing is very clear. Who will notify the central government? Who will notify the accounting standard for the companies? That is nothing but the central government. And under the central government, there is one department called the MCA, that is called the Ministry of Corporate Affairs. Clear? After section 133, friends, we are having the one specific section, that is nothing but the section 134. And that section 134 is related to the director's report. And if that section is related to director's reports, it's a responsibility of the director to write a director responsibility statement that they have applied all the particular accounting standards applicable to the entity. But don't you think so? This particular declaration is a self-declaration. And if this particular declaration is a self-declaration, it is not much more reliable. And if it is not much more reliable, that's why one section is introduced, and that is nothing but the section 143. And under section 143, the auditor has given the responsibility to check whether the company has followed all the applicable accounting standards or not. And if company has not followed any of the particular accounting standard, then simply, friends, auditor can qualify its audit report. Clear? So simply, friends, if you understand, if institute asks a question, write down the compliance of the accounting standard. Basic preparation and the presentation of financial statement is basically a responsibility of the management. As per section 133 of the Companies Act 2013, every company has to follow the accounting standard. As per section 134 of the Companies Act 2013, it's a responsibility of the director to write one statement, director responsibility statement, that company has followed all the applicable accounting standard. And yes, as per section 143 of the Companies Act 2013, auditor has to report whether in his opinion the financial statement is comply with the accounting standard referred under section 133 of the Companies Act 2013 or not. If not, 110% I can tell you, auditor can qualify its audit report. Clear? Perfect. Now, why we are following the accounting standard? If there are some advantage, then only we will follow, otherwise Indian people will not follow. Simple if you ask me. Accounting standard eliminates altogether confusing variation in the accounting treatment used to prepare the financial statement. They are giving the different accounting policies, clear, and whatever the accounting policy is best for you, 110% you can follow. Clear? Second thing, it may be possible some information is very important, but that information is not required by law to present, but under accounting standard we can use the mandatory clause for getting the information from the entity. Clear? So it may be possible some important information are not required by law to be disclosed, but standards may call for the disclosure that required by the law. Clear? And then third, we can easily compare the financial statement of the two different companies at a different places. Clear? These are the advantages, but obviously each coin is having the two sides. There are some disadvantages of the accounting standard also. If you ask me, accounting standard is a rigid, and accounting standard is not giving any flexibility for selecting the accounting policy. Sir, can you give an example? Yes, I can give you. You know very well, under the accounting standard 2 for valuation of inventories, we are having just two methods. Number one is nothing but the FIFO, and the number two is nothing but the weighted average. It may be possible for my industry, for us, FIFO and the weighted average is not much more relevant. For us, LIFO is the best method. But that method is actually not given under accounting standard 2. That's why we cannot apply that LIFO method. So simple. If you ask me, accounting standard is a little bit rigid. Clear? Second change. Choice between the better alternative accounting treatment in a particular situation is eliminated. Clear? So simple. These are the disadvantages. Now, I am starting with the topic accounting standards for the corporate entities. I already told you, under section 133 of the Companies Act 2013, every company has to follow the accounting standard which is notified by the central government. Yes or no? Now problem is that whether central government has any body, answer is yes. Friends, central government has one department, and the name of department is nothing but the MCA, Ministry of Corporate Affairs. Under the Ministry of Corporate Affairs, they have constituted one body. Under section 210A of the Companies Act 1956, and the name of the body is nothing but the NACAS. What is the full form of the NACAS? It is nothing but National Advisory Committee on Accounting Standard. Yes or no? But sir, don't you think so? You are teaching the old company law. Yes, you are right. Friends, this was under the Companies Act 1956. But now, as per section 132 of the Companies Act 2013, they have constituted one body, and the name of the body is nothing but the NAFRA. Friends, what is the full form of the NAFRA? It is nothing but National Financial Reporting Authority. Just remember two names. NACA's full form, National Advisory Committee on Accounting Standard, and the NAFRA full form, National Financial Reporting Authority. And understand that already NAFRA is constituted on the 1st October 2018. Clear? If anyone asks you, how many accounting standards are there? Friends, total there are 32 accounting standards. But out of the 32 accounting standard, 2 accounting standard is already removed. Number 1, accounting standard 6, and the number 2, accounting standard 8. Friends, accounting standard 6 is basically related to the depreciation accounting. That is merged with accounting standard 10 in the year 2016, and the revised accounting standard 10 name is nothing but the property, plant and equipment. Accounting standard 8 is nothing but the accounting for the research and development expense. That is already merged with the accounting standard 26, and now the name of accounting standard 26 is nothing but the intangible asset. So people are telling you there are 32 accounting standards, but friends, out of 32 accounting standard, 2 accounting standard is already removed. So effectively we are having the 30 accounting standard. But the game is that out of 30 accounting standard, 3 accounting standards are such that is already announced by the MCA, but it is not notified by the MCA. And which are that particular accounting standard? That is accounting standard 30, accounting standard 31, and the accounting standard 32. Financial instrument the presentation, and the financial instrument disclosure. That is already announced but not notified. So actually AS 30, 31 and the 32 is not applicable today. So yes, there are 32 accounting standard. Out of 32, 2 accounting standard is already removed. So effectively there are 30 accounting standards, but out of 30 accounting standard, 3 accounting standard is not applicable. So effectively, if you can check, there are 27 accounting standard. Clear? And I already told you, NAFRA was already constituted on the 1st October 2018. Clear? Now my point is that whether accounting standard is applicable to all entities or accounting standard is applicable to companies. Friends, actually accounting standard is applicable to all entities, and that's why we are having accounting standard at 2 different places. One accounting standard is issued by the MCA, Ministry of Corporate Affairs, and the second is issued by the ICAI. Clear? Whatever the Ministry of Corporate Affairs is suggesting, that is for the companies. But whatever is suggestion given by the ICAI, that is applicable to the non-corporate entities. In India, every entity has to follow accounting standard. But yes, friends, please understand. If you are doing the charitable activity, means if you are a trust, then accounting standard is not applicable. But please understand my one word. In trust also, if you are doing the commercial activity of ₹1 only, again I am repeating, in trust also, if you are conducting any of the commercial activity of ₹1 also, then again accounting standard is applicable to all the transactions of the trust. Clear? Means simply, if you are just conducting the charitable activities, then only accounting standard is not applicable. Otherwise, every person of the India will follow the accounting standard. Problem is that ICAI has categorized the entities into the 3 parts: level 1, level 2 and the level 3. Basically, the level 1 entities will be considered as a non-SME, and the level 2 and the level 3 will be considered as a SME, that is called the small and medium sized enterprise. Level 1 people will follow all the accounting standards, but there are some relaxation and there are some exemptions for level 2 and the level 3. But before starting, we have to understand that which entities are covered under the level 1 and the which entities are covered under the level 2 and 3. Clear? So let's start with the level 1. There are 5 conditions of the level 1. Number 1, any entities whose equity or debt either listed or in the process of listing either in India or outside India. Clear? If your equity or debt is listed or you are in the process of listing in India or outside India. Clear? That was my first condition. Number 2 condition, the turnover of the entity, and whenever I am using the turnover, that is excluding other income, is more than ₹50 crore in immediate preceding accounting year. Clear? Number 3rd condition, this is the most important, the borrowing of the entity including the public deposits is more than ₹10 crore. What is very clear, at any time during the preceding accounting year. Means friends, we will not just consider the closing balance, we will check at any time. If at any time my balance of the borrowing is more than 10 crore, accounting standards is applicable. Number 4th condition, any bank, public institutions or the financial institutions or insurance companies, and if you are falling under the level 1, then friends, please understand your holding and subsidiary is also considered as a level 1 entities. Sir, why you are bifurcating the level 1, 2 and 3? Because friends, level 1 will follow all the accounting standards and there are some relaxation for the level 2 and level 3. I use the word holding and subsidiary. If you are having the 100% share of the another entity, then that entity will be considered as a wholly owned subsidiary. If you are having the more than 50% but less than 100%, then it will be considered as a subsidiary. If you are having the exact 50%, then it will be considered as an associate. If you are having the more than 20% but less than 50%, again that will be considered as an associate. If you are having exact 20% share, then again it will be considered as an associate. But if you are having the less than 20%, then it will be considered there is no relationship. Is it okay? Clear? Now let's consider the level 2 entities. There are 3 conditions for the level 2 entities. The turnover of the entity is greater than 1 crore, but less than or equal to 50 crore in immediate preceding accounting year. The borrowing of the entity is greater than 1 crore, but less than or equal to 10 crore at any time during the preceding accounting year. And if you are falling under the level 2 category, your holding and subsidiary is again considered as a level 2. And level 3, simple. If your entity is not covered under the level 1 and the level 2, then that particular entity will be considered as a level 3 entities. Is it okay? Now problem is that it may be possible today you are in level 1 because of the turnover criteria. And in the next year, if you are under the level 2 category, can you go into the level 2 and you can get the exemption in the relaxation? Rule is that if today you are a non-SME and simply now if you are fulfilling the conditions of the level 2 and the level 3, then you are qualified for the exemptions if and only if you are an SME for continuous period of the 2 years. For the continuous period of the 2 years. Clear? Simply then only you will get the benefit. Now there are 4 words. One is nothing but the non-SMC, non-SME, SMC and SME. Friends, if you are a corporate entity and covered under the level 1, then it will be considered as a non-SMC. If you are a corporate entity and covered under the level 2 and the level 3, then it will be considered as SMC. If you are a non-corporate entity covered under level 1, then it will be considered as a non-SME. And if you are a non-corporate entity and covered under the level 2 and the level 3, then it will be considered as an SME. Clear? So my introduction of accounting standard topic is done, and now I am starting with the Ind AS roadmap. Means in your syllabus there are no Ind AS, but yes, in your syllabus there is a topic called the Ind AS applicability. Friends, India has a 2 option. India can select for converted into the Ind AS, or India can select the option of the converged IFRS. Friends, what is the meaning of the converted IFRS? Please take IFRS as it is and ask and told the Indian people to follow the Ind AS from tomorrow. But India has not selected that option. India has adopted the IFRS and the modified IFRS as per the Indian economy, and the new name is nothing but the given as an Ind AS. And now it's time, because in India we want more and more FDI, that is called the foreign direct investment. And in India, if we want the more and more FDI, 110%, what should we do? We have to prepare our financial statement in such a language that all the world can easily understand the financial statement. Clear? And that's why we are selecting the option of the converged IFRS. That is more or less similar to IFRS, but yes, due to the consideration of the Indian economy, we have made some modification. And the IFRS is only and only applicable to, Ind AS is only and only applicable to companies. In July 2014, at that time our finance minister was Mr. Arun Jaitley. He spoke one line in his budget. Now it's time that India have to follow a simple accounting language that is applicable or that is applied by all the countries of the world. And in the month of February 2015, they have introduced Companies Indian Accounting Standard Rules 2015. And in that particular rules, they have disclosed or they have notified the roadmap of the Ind AS. Whenever I use the word the Ind AS roadmap is given in the Companies Indian Accounting Standard Rules 2015, one thing should be clear in your mind: Ind AS is only and only applicable to companies. Other than companies, Ind AS is not applicable. Other than companies, your Ind AS is not applicable. Clear? Whenever I am using the word companies, it may be it is applicable to public company, private company, listed company, unlisted company, government company, Section 8 company, and the one-person company. If that particular entity is incorporated under the Companies Act 2013 or any other previous law, then simply it will be considered as a company, and if they are fulfilling this criteria, then 110% the Ind AS will be applicable. Number 1, from the 1st April 2015 or the later, any company can voluntarily follow Ind AS. Number of students are thinking that this option was given only for the 1st April 2015. If I am incorporating the company today, that is in the month of the November, but I want to apply the Ind AS from the 1st April 2021 voluntarily, can I do so? 110% any company can voluntarily follow Ind AS from the 1st April 2015 or the later period. Clear? Now friends, this will be considered as a phase 1, and this is the mandatory phase 1. Any company whose net worth is 500 crore or more, then compulsorily they have to follow the Ind AS from the 1st April 2016. From the 1st April 2016. Clear? Friends, any company whose net worth is more than or equal to the 500 crore, then that company has to follow the Ind AS from the 1st April 2016. In this case, we are not checking the turnover criteria. We are not checking the borrowing criteria. Basically, if you ask me, we are checking the net worth criteria. Second is nothing but the mandatory phase number 2. Any listed company, irrespective of the net worth, means we will not check the net worth. If your net worth is a negative, but you are a listed company, then you are falling in the phase 2. Except if your company is listed on the SME, that is called the small and medium exchange, and for other company whose net worth is more than or equal to 250 crore, then they have to follow the Ind AS from the 1st April 2017. This is 1st April 16, and the phase number 2 is starting from the 1st April 17. Now please focus what I am trying to convey here. Friends, any Indian company can voluntarily follow Ind AS from the 1st April 2015 or for the later period. Every company whose net worth is more than or equal to 500 crore should mandatorily follow the Ind AS from the 1st April 2016. Any listed company, irrespective of the net worth, and the other company whose net worth is more than or equal to 250 crore, then Ind AS is applicable from the 1st April 2017. Now please understand, if you are following the Ind AS, then your holding, subsidiary, associate and joint venture should mandatorily follow Ind AS. Yes, understand, if you are following the Ind AS voluntarily, means from the 1st April 2021, if I am following the Ind AS voluntarily, no doubt I am following very voluntarily, but if I am following, my entire group will follow them mandatorily. Clear? Second thing, once Ind AS is applicable, then it is applicable for the lifetime. Again I am repeating, once Ind AS is applicable, then it is applicable for the lifetime. That thing should be clear in your mind. Clear? Second thing, not a single rule till date I spoke is applicable to bank, NBFC and insurance company. Clear? We will learn how this rule is applicable to bank, NBFC and an insurance company, but before that, I told you have to check the net worth. Friends, first time, we will check the net worth on the 31st March 14. You should actually take an example. If 31st March 14, my net worth is a 605 crore, Ind AS is applicable from the 1st April 2016. Let's assume for the same company, on the 31st March 16, if they are checking the net worth, my net worth is, let's assume, just the 5 crore, still Ind AS is applicable, because on 31st March 14, when I check the net worth, my net worth is a more than 500 crore, and if my net worth is a more than 500 crore, on that date it was fixed, Ind AS is applicable from the 1st April 2016. Clear? Obviously, it may be the possible, it's an opposite case. Sir, means what you are trying to convey. On 31st March 14, when I check my net worth is just a 5 crore. And if my net worth is just a 5 crore, obviously I am not in the scope of the Ind AS, means Ind AS is not applicable. But for the same company, if I check the net worth on 31st March 16, on 31st March 16, that net worth is nothing but the 605 crore. Friends, Ind AS is applicable from the tomorrow, means this Ind AS is applicable from the 1st April 2016. So you should consider this point. Clear? Friends, please listen on my word. We will check a net worth first time on 31st March 14, and obviously that net worth should be checked on the basis of the stand-alone financial statement and not on the basis of the consolidated financial statement. Clear? Next and the most important point, we are always following the strict condition. If you are focusing on my word, I want to convey that we are checking the net worth on 31st March 14. We are not checking the listing criteria on 31st March 14. We will check the listing criteria on the 1st April 2017 only. Again, I am repeating, on the 1st April 2017. It may be possible. On 31st March 14, my company is listed and my net worth is 5 crore. I can tell you Ind AS is not applicable. Reason, we are not checking the listed criteria on 31st March 14. Actually, we will check the listed criteria on the 1st April 17. But yes, on my 31st March 14, my company was listed, but on the 1st April 17, my company is again listed, then Ind AS is applicable irrespective of the net worth. It may be possible. On 31st March 14, my company was listed, but on 1st April 2017, my company is unlisted. Ind AS is not applicable. Reverse if I take, on 31st March 14, my company was unlisted, but on 1st April 2017, my company is listed. Ind AS is applicable. So listing criteria will be checked on the 1st April 2017. Clear? I already told you this rule is not applicable to bank, NBFC and insurance company. So if we discuss for the NBFC, just understand everything is a 2 years later. If I speak official language, if any NBFC whose net worth is more than or equal to 500 crore, then Ind AS will be applicable from the 1st April 2018. 1st April 2018. If any NBFC is a listed NBFC, irrespective of the net worth, but if your NBFC is listed on the SME, then Ind AS is it will not be considered as a listed. And for the other NBFC whose net worth is a more than or equal to 250 crore, then Ind AS will be applicable from the 1st April 2019. So please understand what I am trying to convey. For normal company, if it was 16, then for NBFC it's an 18. For normal company, if it was on 17, then for NBFC it is on 19. Clear? If NBFC covered, also holding, subsidiary, associate and joint venture is also covered. Clear? Next, if I take for the bank and insurance company, then friends, for the bank, please understand, it is notified by the RBI and they have played a superb game. First of all, as per the RBI notification dated on 11th February 2016, they had applied the Ind AS from the 1st April 2018. Then that was deferred from the 1st up to 1st April 2019. But yes, on 22nd March 2019, they have issued one notification, and as per that notification, bank will not apply Ind AS till further notice. Bank will not apply Ind AS till further notice. Means if I discuss today, actually the Ind AS is not applicable to bank. Clear? If we discuss for the insurance companies, for insurance companies we are having one specific body called the IRDA, Insurance Regulatory Development Authority of India, and they are thinking to follow the Ind AS from the 1st April 20, but now this is again changed and now they will apply the Ind AS from the 1st April 2021. Clear? Is it okay for the bank and insurance company? 110% it may be possible you are following the Ind AS from today, but it is not like the rule. If you are following the Ind AS from the today and if you are having a subsidiary and that subsidiary is the NBFC, then simply for NBFC we are having a specific criteria and they will not follow the accounting or rather Ind AS today. Problem is that my reporting entity will prepare the stand-alone financial statement as per the Ind AS. His subsidiary will prepare their stand-alone financial statement as per the accounting standard. But understand that the reporting entity has to prepare their consolidated financial statement as per the Ind AS only. So what should we do? It's whenever the accounting policies is different for the holding and the subsidiary, it's a responsibility of the subsidiary, associate and joint venture to convert their entire data as per the holding company. Clear? Whenever you are applying the Ind AS for the first time, friends, you have to prepare 3 balance sheet. Focus on my word. I have not told you you have to prepare 3 financial statement. My word is very clear. You have to prepare 3 balance sheet. Means friends, what? If I am following the Ind AS from the 1st April 2016, I will prepare my first balance sheet on 31st March 17, second balance sheet on the 31st March 16, and the third balance sheet is on the 1st April 2015. So if anyone told you your applicability date of the Ind AS is the 1st April 2016, but your transition date of Ind AS is the 1st April 2015. Clear? Simply, if you are in India, if your subsidiary, associate or joint venture is out of India, it may be possible. This is a reverse case. If you are in India, but your holding is outside India, Simply, if they are not in India, they will not follow our accounting standard or our Ind AS. They will follow the particular accounting standards applicable in their jurisdiction. Simply, so you will have to focus. And how we will calculate net worth? Net worth should be calculated as per section 2, subsection 57 of the Companies Act 2013. And it is nothing but the paid up share capital, reserve created out of the profit, securities premium, accumulated losses, deferred or miscellaneous expenditure not written off. And obviously, whenever we are calculating the net worth, it should be as per the standalone financial statement. Perfect. Can I go ahead? So finally, in half an hour, I have covered my topic of the introduction of accounting standard and the introduction of Ind AS. Now we are starting the discussion of particular accounting standard. Let's start with accounting standard 1, disclosure of accounting policies. Friends, there are two elements here. First of all, you should understand the meaning of the accounting policy. And the second, we will understand the disclosure of accounting policy. What is accounting policy? Friends, accounting policy is nothing but the specific accounting principles and the methods of applying those principles. So we learn one new word, and that word is nothing but the principle. So what is the principle? Principle is nothing but, friends, defined solution for the defined problem. Before accounting standard 2, there was a problem. Whether we have to value the inventory or we don't have to value the inventory. Answer is very clear. You have to value the inventory for the purpose of the financial statement. How to apply those methods? And for that, we are having the two methods. Number 1 is a FIFO and the number 2 is nothing but the weighted average. Number of students are thinking that we are using our accounting policies just for the purpose of the accounting. Answer is no. You are not using your accounting policy only at the time of preparation, but you are using your accounting for the presentation purpose also. For the presentation purpose also. Clear? Sir, can you give an example? Yes, I can give an example. As per accounting standard 12, if we are receiving any amount of the government grant, then how to disclose that government grant? Basically, we are having a two choice. Number 1, we can deduct that amount of the government grant from the cost of the asset also, or we can transfer that amount of the government grant into the deferred government grant. Clear? This is a completely choice with the entity. Clear? Next, I am having the various example like for under accounting standard 2 for valuation of inventory, we are having the method FIFO and the weighted average. For the valuation of the fixed asset, we are having for subsequent measurement, we are having a two choice. We can use the cost model or we can use the revaluation model. And I already given example for the government grant. Whenever we are preparing the financial statement, friends, we have to prepare a balance sheet that shows the financial position on a particular date. We will prepare the statement of the profit and loss that will show the financial performance for the particular year. We will also disclose the statement of the changes in equity, means changes in the reserves and surplus. We will also present the cash flow statement, means we are receiving the cash flow from the operating activities, investing activity and the financing activity. And then last and the most important part, we have to disclose all the accounting policies in the notes to accounts. Now understand this point. Every accounting policies should be disclosed at a one place so readers can perceive the effect of the same. Now what is the meaning of the perceive? Perceive means nothing but the understand the effects of the same. You cannot write the inventories accounting policy on the 3rd page and the property, plant and equipment accounting policy on the 7th page and the government grant accounting policy on 13th page and the investment accounting policy on 15th page and employee benefit expense accounting policy on the last page. No, it's not like that. Every accounting policy should be disclosed at a one place so the readers can understand the effect of the same. Again, you cannot disclose your accounting policy in the in director's report, because please understand, director's report is not your part of financial statement. We have to disclose our accounting policy in the notes to accounts only, and that is our part of financial statement. Yes, if some accounting policy is not that much material, then if you are not disclosing that accounting policy, then it will be okay. Now please understand, if you are applying the wrong accounting policy, or if you are applying the inappropriate accounting policy, after that application of accounting policy, you are trying to be honest and you are writing that accounting policy in the notes to accounts, then it is not like that your financial statement is now true and fair. Sir, can you repeat? Yes. If you are applying your wrong accounting policy, or if you are applying the inappropriate accounting policy, and then afterwards you are trying to be honest, and afterwards you are disclosing that accounting policy in the notes to accounts, and you ask every people, no doubt we had followed the wrong policy, but we had disclosed in the notes to accounts, so now it will be correct, and now our financial statement is true and fair. It is like that. First of all, I am doing the murder. After murder, I am surrender myself in the police station and I am trying to be honest. No, it was a crime means crime. So simply if you are following the LIFO method for the valuation of inventory, afterwards you are writing that LIFO method in the notes to accounts, then it will not be like that. You are honest and you have disclosed that method in the notes to accounts. No, simply, so disclosure of accounting policy or of the changes therein cannot be a remedy, means it's a solution for a wrong or the inappropriate treatment in the financial statement. Can I go ahead? Second check. There are three fundamental accounting assumptions. Number one is a going concern, number two is a consistency, and then number three is nothing but the accrual. What is the meaning of the accounting assumption? In India, if anyone preparing accounts, that it's assumed that person will follow this particular three basic concept. Let's understand one by one. First of all, what is the meaning of the going concern? Friends, going concern is nothing but your business should continue for the foreseeable future. Don't write for the long term, don't write for indefinite period, don't write for the unlimited period. Wording is very clear. Your business should continue for the foreseeable future. Foreseeable means for the near 1 to 2 years. Friends, please understand. In India, it's a rule. It's assumed everyone is following the particular fundamental accounting assumption. If you are following the accounting assumption, then disclosure is not required. But yes, if you are violating any of the fundamental accounting assumption, then you have to disclose. But yes, most important thing is that if you are violating the going concern concept, means friends, what I am trying to convey, if you are violating the going concern concept, means your management is trying to discontinue the business, then simply it's a violation of the going concern, and in that situation, you should prepare your financial statement on the non-going concern basis. Clear? And what is a non-going concern? Every assets and liabilities should be measured at a carrying amount or the fair value less cost to sell, whichever is lower. Next, if I go ahead, consistency. Consistency means what? For the similar nature of item, you have to follow the same accounting policy for a year by year. Means you cannot do like this. For current year, for valuation of inventory, you are following the FIFO method. In the next year, for the valuation of inventory, you are following the weighted average method. No, for the similar nature of item, you have to follow the same accounting policy. And the next is nothing but the accrual. Means every transaction should be recorded on the due basis and not on the cash basis. Again, I am repeating, every transaction should be recorded on the due basis and not on the cash basis. Clear? I already told you, whenever you are following the fundamental accounting assumption, then disclosure is not required. But if you are violating any of the fundamental accounting assumption, then you have to disclose in the notes to accounts. Next point. Can we change our accounting policy? In the fundamental accounting assumption, I already told you, we have learned one topic that is called consistency. What is the meaning of the consistency? You have to follow the same accounting policy for the year by year. So if anyone asks you, can we change an accounting policy? Your first answer should be no. But yes, we can change in a three situation. Number one, if it is required by law, if it is required by for the accounting standard, or the number three, that is nothing but for the better preparation and presentation of financial statement. Friends, whenever you are changing your accounting policy, you should give 4 disclosure minimum. Old policy, new policy, reason for the change, and the impact on P&L. Can you give an example? Yes. First of all, I was following the FIFO method and now I am following the weighted average method, and as per FIFO, my closing stock was ₹100, and as per weighted average, my closing stock is a 120. So don't you think so? My closing stock is increased by 20, and if my closing stock is increasing, obviously your profit is increasing, but that profit is increasing because of the change in accounting policy. So such fact should be disclosed in the notes to accounts. Clear? Second thing, whenever you are selecting the accounting policy, first of all, you should understand that your financial statement should be true and fair. But at the time of the selection of accounting policies, we will consider 3 points. Number 1, prudence. Number 2, substance over form, and the number 3 is materiality. Number of students are combining the answer. If instead you ask what are the fundamental accounting assumptions, then you should write 3 things only, but which are the 3 things? Going concern, consistency, and accrual. But whenever they ask the question how to select an accounting policy, then again you have to write 3 things: prudence, substance over form, and the materiality. Friends, what is the meaning of the prudence? Prudence means nothing but we will consider the future expenses or future losses, but we are not considering the future gain. Means your profit should not be overstated, your expense should not be understated, your assets should not be overstated, and your liability should not be understated. Clear? Number 2, substance over form. Friends, substance over form is nothing but we will check the legal matter of the transaction, but we are not, opposite. We will check the reality of the transaction and we will not check the legal matter of the transaction. And the best example is nothing but the hire purchase. Whenever you are taking any asset on the hire purchase, you are a legal owner only when you are paying the last installment. But without anything, we are recording the asset from the very first day. That is called the substance over form. Materiality. Materiality is nothing but the important item. Materiality is nothing but the important item. Means friends what? Means friends what? Just focus here. You should consider materiality means any item of the financial statement which can affect the decision of the readers of the financial statement. There are two types of materiality. One is a quantitative and the second is a qualitative. Where the amount or the units is important, then it will be considered as a quantitative. But where the nature of the transaction is important, then it will be considered as a qualitative. Is it okay? Now if I go ahead, simple, every material item should be disclosed separately. Sir, can you give an example? Yes. As per the Companies Act 2013, it is a rule, if you are incurring any expense or income of the 1% of the turnover or the 1 lakh rupees, whichever is higher, then you have to disclose separately. Number 2, if any person or any entity is having the more than 5% share of your company, then you have to disclose the name of that person and the holding in the notes to accounts. Clear? So finally, I am ending my accounting standard 1. Let's start accounting standard 2, and that is nothing but the valuation of inventories. Friends, first of all, before starting the meaning of the inventory, you should understand the meaning of an asset. Friends, actually, the asset means any resource which is owned or controlled by an enterprise as a result of a past event from which future economic benefit is expected. And what is the meaning of actually the fixed asset? Friends, fixed asset, what is the meaning of inventory? Inventory means any asset which is held for sale, which is held for consumption in production of goods or the rendering of services, and which is a part of production process. Whenever I am using the word which is held for sale, so I am talking about the finished goods. Whenever I am talking the word which is held for consumption in production of goods or the rendering of services, I am talking about the raw material. But whenever I am using the word which is a part of production process, I am talking about the work in progress. Friends, you know very well, every accounting standard has some non-applicability. So accounting standard 2 is basically not applicable to producers of the agriculture and the forest product. Again, I want to clarify, this is not applicable to the producers. If that person is a trader, then accounting standard 2 is applicable. Number 2, if you are trading in the financial instruments, means if you are having the shares or debentures and you are doing the daily transactions in that, then again your accounting standard 2 will not be applicable, but in that case your accounting standard 13 will be applicable. Number 3, work in progress of the construction contract, and number 4, that is nothing but the service providers. Clear? At that particular 4 places, my accounting standard 2 will not be applicable. If I go ahead, then simply, friends, in the definition we have learned that there are 3 types of inventory. One is a finished goods, second is a WIP, and third is nothing but the raw material. I am starting the rule for the finished goods and the WIP both. And the rule is nothing but you have to value the finished goods or the WIP at a cost or NRV whichever is lower. Number of students are thinking that this rule is only applicable to the finished goods. No, it's not like that. This rule is applicable to finished goods and work in progress both. Friends, whenever you are determining the value of the inventory by using the method cost or NRV whichever is lower, please understand that this should be applied on individual basis. Means if you are having the 3 inventory, directly you cannot compare the total of the cost of all the 3 inventories and total of the NRV of the 3 inventories. You have to check one by one. Clear? Now you should understand what things are included in the cost of inventory. Whenever I am using the word the cost of inventory basically includes purchase price. Number 2, conversion cost. And the number 3, that is nothing but the any cost incurred bringing the inventory to its present location and condition. In a short form, we can use the word the directly attributable cost. When I use the word purchase price, friends, purchase price includes any non-refundable import duties and taxes. Simple, if you ask me, if any duty or taxes is included in the purchase price, and if you are eligible to take the credit or refund of the duty or taxes, then obviously it should be deducted from the purchase price. But if in the purchase price some duty or taxes is included, and if you are not eligible to take the credit or refund of that duty or taxes, then it should not be deducted from the purchase price. If in the purchase price some trade discount is included, obviously it should be deducted from the purchase price. But if in the purchase price some cash discount is included, then it should not be deducted from the purchase price. Number 2, conversion cost. Friends, what is the meaning of the conversion cost? Conversion cost is nothing but the any cost incurred for converting raw material into the finished goods. Friends, if you ask me, in a conversion cost, basically 2 things is included. One is the labor, and the second is nothing but the overhead. Obviously, the labor and the variable overhead we are having is a per unit only. But can I say we are having the fixed overhead in the total? And if you are having the fixed overhead in the total, then you should find out the recovery rate. Means how can we find out? Simply remember one line: fixed overhead is always absorbed on the basis of actual capacity or normal capacity, whichever is higher. Again I am repeating, actual capacity or the normal capacity, whichever is higher. Clear? Next and the most important point, third point, that is nothing but the directly attributable cost. Means if we are incurring any transportation expense, if we are incurring any designing cost, then simply that particular thing will be considered as a directly attributable cost. After that, you should also understand that which thing is not considered in the cost of inventory. Basically, if you check accounting standard 2, then only 4 things is given, but I have written 5 things and I will explain how it is 5 things. Number 1, if you are incurring any selling cost, admin cost, storage cost, interest cost, and the abnormal loss. Selling cost is basically not a cost incurred for manufacturing in the inventory, but that cost is incurred for selling of the inventory. Admin cost means account department has no relevance to the manufacturing department. Storage cost. Friends, please understand, even we will not consider the storage cost of the perishable goods, but you should understand that if we are incurring any storage cost for the raw material, and that's necessary, then we can consider that. Clear? Interest cost. But yes, this interest cost is subject to accounting standard 16. Means normally interest cost is not added in the cost of inventory. Repeating, interest cost is not added in the cost of inventory. But understand my one point, if accounting standard 16 allows, we can add the interest cost in the cost of inventory. And you know very well the accounting standard 16 is nothing but the borrowing cost. And as per accounting standard 16, the borrowing cost is only capitalized if that asset is a qualifying asset. And friends, what is the meaning of the qualifying asset? Qualifying asset means any asset which take substantial period of time for ready to use. And what is the meaning of the substantial period of time? Substantial period of time is nothing but the 12 months or more. Simply, if I am having the business of the liquor, and if I am having the business of the liquor, that is nothing but my inventory for me. But can I say, you know very well, the liquor takes the lengthy maturation process, and if the liquor takes the lengthy maturation process, obviously that asset is a qualifying asset. And if we are borrowing some fund for manufacturing of that liquor, means for manufacturing of that inventory, 110%, whatever interest expense I am incurring, that interest expense is capitalized in the cost of inventory. Clear? Perfect? Okay. Now, next word you should understand, that is nothing but the net realizable value. Friends, NRV is nothing but the expected selling price minus expected completion cost minus expected selling cost. Whenever I am here writing the expected selling price, I will take the expected selling price of the finished goods. If you are comfortable with the concept, I want to explain that if this word expected cost of completion is not written here, I can tell you, this rule is only applicable to finished goods. But here this word is very clearly written, that is nothing but the expected cost of completion. Means here we are taking the selling price of the finished goods, but now if you are doing the valuation of the WIP, so obviously you have to incur some cost for converting the WIP into the finished goods, and that processing cost is deducted from here. And yes, if you are incurring any selling cost, then again it will be deducted. Now if I discuss the main topic, that is called the joint product and the byproduct. In costing you learn this topic. In a joint product, in the byproduct, actually the raw material is the same. But if you ask me, sir, what is the single line difference between the joint product and the byproduct? Friends, the economic importance of the main product is higher compared to the economic importance of the byproduct. If you ask me, the byproduct is basically considered as a scrap only. And how we will value the inventory of the joint product and the byproduct? Friends, first of all, you should determine the joint cost. From that joint cost, we will deduct net realizable value of the byproduct. Net realizable value of the byproduct. Whatever my net joint cost, that net joint cost will be allocated among the main product in the ratio of their fair value. Again, I am repeating, allocated in the among the main product in the ratio of their fair value. So if you consider a step, first of all, find out the joint cost. From joint cost, we will deduct the net realizable value of the byproduct. Whatever my net joint cost, that is allocated between the main product in the ratio of their sales value. Clear? And there is one topic that is called the valuation of the raw material, because till date we have learned the valuation of the finished goods and the WIP. Now let's start with the valuation of the raw material. Friends, for finding out the valuation of the raw material, first of all, we will consider the base of the finished goods. If the net realizable value of the finished goods is more than or equal to its cost, then the raw material will be valued at cost. But if the net realizable value of the finished goods is lower than its cost, then raw material will be valued at a cost or replacement cost, whichever is lower. Clear? So obviously for valuation of the raw material, we will check that. Clear? Simply my accounting standard 2 done here. Now I am starting the most important accounting standard of the group 1, that is nothing but accounting standard 10, property, plant and equipment. Yes, then property, plant and equipment. First of all, if we discuss the meaning of an asset, friends, basically asset is any resource which is owned or controlled by an enterprise as a result of a past event from which future economic benefit is expected. But now the most important thing is that nothing but what is the meaning of the property, plant and equipment, means what is the meaning of the fixed asset. Friends, fixed asset means any asset which is not held for sale, which is held for consumption in production of goods or the rendering of services, or rental to others, or for the administrative purpose, and the life of the asset is more than one accounting year. Friends, you should understand that they have clearly used the word more than one accounting year. It's not more than 1 year. If I take an example, if I acquired one asset on the 1st April 2019 and the life of the asset is up to 1 year, means I have to dispose that asset on 31st March 2020. Second asset I acquired on the 1st January 19 and the life of the asset is up to 31st December 2019, means up to 1 year. In both the case, the life of the asset is actually the 1 year, but still in the second case it will be considered as a fixed asset, but in the first case it will not be considered as a fixed asset. Clear? Sir, how can we determine that in the second case it will be considered as a fixed asset? Because in the first case, the life of the asset is for the period from the 1st April 19 to 31st March 20. So it's exactly 1 year, and it is exactly one accounting year, that is nothing but the 2019-20. But in the second case, I have acquired one asset on the 1st January 2019, means in the accounting year 2018-19, and in the second case, that is acquired on the 31st, disposed on 31st December 19, that is for the period 2019-20. So it's more than one accounting year, and if it is a more than one accounting year, your accounting standard 10 will be applicable. Clear? Now you should understand the non-applicability, and this is the most important first point. Any biological asset related to agriculture produce other than bearer plant. So first of all, you should understand the meaning of the biological asset. Friends, biological asset means any living animal or any living plant. If any living animal or plant is related to agriculture produce, then accounting standard 10 is not applicable. But if it is not related to agriculture produce, 110% your accounting standard 10 will be applicable. Sir, can you give an example? Yes. If you are having any pet, then simply that pet not gives you any future economic benefit, and if that pet not gives you any future economic benefit, accounting standard 10 will not be applicable. But yes, if you are using any horse in the horse race, simply you are not using any horse for the commercial activity, for the agriculture activity, but you are using that horse for the commercial activity, your accounting standard 10 will be applicable. They have clear, if you are using any birds and animals in the circus or the zoo, then again your accounting standard 10 will be applicable. But friends, please understand what I am trying to convey. Other than bearer plant, means on bearer plant, your accounting standard 10 is applicable. AS10 clearly given you. Accounting standard 10 is only applicable to the bearer plant, but it is not applicable to the produce of the bearer plant. Means on mango tree, your accounting standard 10 is applicable, but on mango, your accounting standard 10 will not applicable. On orange tree, your accounting standard 10 is applicable, but on orange, your accounting standard 10 is not applicable. And obviously, if that is the crop of the wheat and rice, then your accounting standard 10 will not be applicable. Number 2, if you are having any wasting asset, or if you are incurring any expense on the exploration and the evaluation of the mineral resources or the wasting asset, then simple your accounting standard 10 will not be applicable. Whenever we are having any specific accounting standard, that specific accounting standard will overrule our general accounting standard. Best example is the thing, but if we are taking any asset on the lease, then we are not doing the accounting as per the accounting standard 10, but we will use the accounting standard 19 for the accounting of the lease contract. And obviously number 4, that is nothing but the investment property. Means if you are acquiring any land and building specifically for the purpose of giving of that land and building on the rent or for the capital appreciation, then simply it will be considered as an investment property. And whenever it's an investment property, friends, only your cost model is applicable, revaluation model is not applicable. Clear? I already explained the definition of the biological asset and all. Example, that mango tree. Now, if we determine that this particular asset is a property, plant and equipment within the scope of accounting standard 10, when we can recognize that particular asset in my books of accounts? If that particular asset fulfills the recognition criteria, then only you can recognize in your books of accounts. And what is the recognition criteria? Number 1, the cost of the asset should be measured reliably. And number 2, it is expected that the future economic benefits will flow to the entity. You have to fulfill all the 2 conditions, and if you are fulfilling the both conditions, you can recognize that particular asset in your books of accounts. Next, if I discuss, whenever you are purchasing the asset, which expense you should capitalize? You will capitalize purchase price. Number 2, any cost incurred bringing the property, plant and equipment to its present location and the condition, means the directly attributable cost. And the number 3, present value of the dismantling or the restoration cost. Friends, if we consider the purchase price, friends, if in the purchase price some duty or taxes is included, and if you are eligible to take the credit or refund of that duty or taxes, then it should be deducted from the purchase price. But if in the purchase price some duty or taxes is included, and if you are not eligible to take the credit or refund of the duty or taxes, then it should not be deducted from the purchase price. If in the purchase price some trade discount is included, then obviously it should be deducted from the purchase price. But if in the purchase price some cash discount is included, then it should not be deducted from the purchase price. Any cost incurred bringing the fixed asset to its present location and conditions, means if you are incurring any of the cost up to the asset ready to use, then simply that all expense is capitalized with the cost of the asset. And the number 3, present value of the dismantling or the restoration cost. This is the most important point. If you have attended my lecture in class, I have taken one story. One day in the morning, Vodafone people came at my home. They asked me to install the tower at my terrace. I asked for how many years? They replied me for the 10 years. So I again told him, after 10 years, whenever you are dismantling, means whenever you are removing that particular tower from my terrace, then my terrace should be in the normal condition. But you know very well, my terrace is not in the normal condition. At that time, my terrace will be in the damaged condition. So I told him, you have to give my terrace after restoring. Means in whatever conditions I am giving my terrace, I want my terrace after 10 years in as it is condition. So don't you think so? Vodafone people have to incur some expenses in the future. They don't know how much, so they are estimating the amount, and let's say the amount estimated is nothing but the 10 lakh. But that 10 lakh will be considered as a future value. We have to discount that 10 lakh, and by discounting that 10 lakh, we will calculate the present value. And that present value of the dismantling cost is added in the cost of the asset, and for that amount we will make one provision. Please understand that amount of the provision will be increasing day by day, but the balance of the asset is decreasing day by day. Why the amount of the provision increasing day by day? Because of the interest expense due to unwinding of the discount. And why the balance of the asset is decreasing day by day? Because of the depreciation. Then I have started the new topic, that is nothing but, can we recognize the self-generated asset in my books of accounts? Yes, you can recognize the self-generated asset in your books of accounts except self-generated goodwill. And which expense you should capitalize? Material, labor and the overhead. But yes, if you are incurring any of the internal profit, that internal profit should be eliminated from the cost of the asset. Clear? Then simply I have started the exchange of the asset. Whenever you are doing the exchange of the asset, the new asset will be recognized at fair value of asset given or fair value of asset taken, whichever is more clearly evident. And what is the meaning of the fair value? Friends, actually the fair value is nothing but the fair value is the price that would be received when asset is sold, that would be paid when the liability is transferred in an orderly transaction between the market participants on a measurement date. So basically they are following the concept of the exit price and not the entry price. Please remember my thumb rule. If in the question you are having the both fair value of asset given also and the fair value of the asset taken also, then for you fair value of asset given is a more clearly evident. Remember my word, for you fair value of asset given is more clearly evident. But yes, if in the question there is no data of the fair value of asset given, then we will take the base of the fair value of the asset taken. This was my basic rule. But yes, in a two situation we are using our exceptional rule. Number one, when the transaction lacks commercial substance, and the number two, the fair value of the asset given and asset taken is not measured reliably. Clear? How can we say that the transaction has commercial substance and the transaction lacks commercial substance? If after exchange of the asset, if you are estimating that your future cash flows will change, then we can say that the transaction has commercial substance. But if after exchange of the asset, if you are estimating that your future cash flows will not change, then we can say that the transaction lacks commercial substance. And whenever you are using the exceptional rule, in exceptional rule, friends, please understand, you should recognize the new asset at book value of asset given less cash received, if any. Book value of asset given less cash received, if any. Clear? Simple. This is the topic of the exchange of the asset. Then simple, if you are taking any asset on the hire purchase, then the new asset will be recognized at a cash price. If you are purchasing the two or more asset at a consolidated price, then compulsorily you should bifurcate, or you should apportion the consideration in the ratio of the fair value of the asset. And number three, if any asset is a jointly held asset, then simply it will be recognized at a pro rata cost. Next, if I go ahead, for subsequent measurement of the property, plant and equipment, friends, you are having a two choice. Number one, you can use the cost model, or the number two, you can use the revaluation model. But simple, whatever the model you want to follow, that is a completely choice with the entity. It is an accounting policy adopted by the entity. But that policy should be followed for the entire class of the asset. Friends, what is the meaning of the class of the asset? The grouping of the asset having the similar nature, having the similar usage, and at a same location. If I am having the factory building, if I am having the office building, both can be considered as a different class of asset, and I can use the different method. But if I am having the one factory building, if I am having the second factory building, I cannot follow the cost model for the one factory but the revaluation model for the another factory, because the group of asset is considered as a single class of asset, and for the single class of asset I cannot use a different accounting policy. But if you are following the cost model, then asset will be disclosed at historical cost minus accumulated depreciation and minus accumulated impairment loss, if any. But yes, if you are following the revaluation model, then maximum revaluation is allowed up to the recoverable amount of the asset, And friends, please understand, whenever you are doing the first time upward revaluation, then your entry should be asset account debit to revaluation reserve. Please remember, you have to find out the depreciation by giving the prospective effect. Whatever the depreciation is directly charged to P&L. But yes, if there is any excess depreciation because of the revaluation, then it should be transferred from the revaluation surplus to revenue reserve. Clear? Second point, whenever you are doing the downward revaluation, your entry should be P&L account debit to asset account. But if it is the case of the first time upward, then downward, then friends, entire loss is not debited to P&L. First of all, the loss is adjusted against the balance of the revaluation surplus, and the remaining loss will be debited to P&L. But if it is the case of the first time downward, then upward, entire gain is not credited to revaluation reserve. First of all, the gain is credited to P&L. How much? The difference between the book value with downward revaluation and the book value without downward revaluation. Remember my 3 line for the revaluation. An entity may transfer the difference between the depreciation based on revalued carrying amount and the depreciation based on original cost from revaluation surplus to revenue reserve. From revaluation surplus to revenue reserve. Number 2, if any revalued fixed asset is derecognized, then the balance of the revaluation surplus should be transferred to the revenue reserve. And then number 3, all transfer from the revaluation surplus to revenue reserve are made directly and not routed through profit and loss account. Clear? Next point, whenever you are doing the revaluation of the asset, you have to adjust the balance of the accumulated depreciation. And for that adjustment, you are having a 2 method. Number 1, you can adjust the gross block and accumulated depreciation proportionately. And the number 2, eliminate the balance of the accumulated depreciation. Clear? Then simply friends, whenever you are, just a minute. Okay, let's take first point. Whenever you are changing your dismantling cost, and at the time of the changing of the dismantling cost, if you are adopting the cost model, then if your amount of the provision is increasing, then your entry should be asset account debit to provision account. If your amount of the provision is decreasing, your entry should be provision account debit to asset account. But you should ensure that if you are increasing in the amount of the provision, resultantly your balance of the asset is also increasing. And resultantly, if your balance of the asset is also increasing, you should ensure that your amount of the asset should not be more than the recoverable amount of the asset. If you are decreasing the amount of the provision, resultantly your amount of the asset is also decreasing, but you should ensure that your asset should not be now in the negative figure. Clear? If yes, then simply you should credit the excess amount to the P&L. But yes, if you are following the revaluation model and if your amount of the provision is increasing, then your entry should be revaluation reserve account debit to provision account. If your amount of the provision is decreasing, your entry should be provision account debit to revaluation reserve account. You should ensure that if your amount of the provision is increasing and if you are not having the sufficient balance in the revaluation surplus, then excess amount is debited to P&L. But if your amount of the provision is decreasing, then simply your revaluation reserve balance is increasing, and you should ensure that that balance of the revaluation surplus should not be more than the carrying amount of the asset. Clear? Then I have started the depreciation. Friends, depreciation is nothing but the systematic allocation of the total cost of the tangible assets over its useful life. AS10 has not specified any method, but yes friends, please understand my one line. Depreciation is started when your asset is ready to use, and when you should cease the depreciation means when you should stop the depreciation, when that asset is retired from the active use, or whenever you are disposing this asset, you are planning to dispose this asset, then simply in that situation you should not provide any depreciation. Clear? Now the most important point is that whenever you are changing the depreciation method, that change in depreciation method is not considered as a change in accounting policy, but it will be considered as a change in accounting estimate. And whenever it is a change in accounting estimate, friends, you should provide the prospective effect and you should not provide the retrospective effect. Clear? So finally, I am ending our most important accounting standard 10. Then let's start with the accounting standard 11, effects of changes in foreign exchange rate. Clear? Now please focus here. In accounting standard 11, we are learning 3 things. Number 1, the foreign exchange transaction. Number 2 is nothing but the foreign exchange operation, and number 3, that is nothing but the basics of the hedge accounting. Now if I discuss with the foreign exchange transaction, friends, if you are entering any transaction into the foreign currency, then it will be considered as a foreign exchange transaction. That foreign exchange transaction initially should be recorded on the date of transaction. In a technical language, I can tell you it will be recorded at a spot rate. Clear? But problem is that this is my initial recognition. Subsequently, on the balance sheet date, if we are having the non-monetary item which are carried at a historical cost, should be continued at a historical cost. Best example is a property, plant and equipment. If we are having the non-monetary item which is considered at a fair value, should be disclosed at a fair value. Best example is nothing but the inventory. But yes, if you are having any foreign currency monetary item, should be converted at the closing rate on the reporting date. Obviously, whenever you are converting your foreign currency monetary item at a closing rate, you will find some gain or loss, and that gain or loss is transferred to P&L. Basically, we are getting the foreign exchange gain or loss because of the two things. Number one, conversion of the foreign currency monetary item at a closing rate on the reporting date. And the number two, whenever we are doing the settlement of the foreign currency monetary item. And whatever the gain or loss we are finding, that gain or loss should be transferred to the statement of profit and loss immediately. Clear? But yes, for that purpose, you have to learn what is the meaning of the foreign currency monetary item. Friends, foreign currency monetary item means any asset or liability whose settlement or realization will be in the fixed or in the determinable amount of the currency. If you ask me the example, cash, debtor, creditor, bills receivable, bills payable, loans and the borrowing, that will be considered as a foreign currency monetary item. This was the easy topic. But yes, the most important topic is nothing but the para 46 or the 46A of the accounting standard 11. Let's go into the history. Friends, before the year 2006, we have Companies Act 1956. Under Companies Act 1956, we are having the Schedule 6 for preparation of the financial statement, and at that time we are having the accounting standard. If there is, at that time, if there is any contradiction between the accounting standard and the Schedule 6, then simply, friends, my Schedule 6 overrules the accounting standard, means Schedule 6 prevails the accounting standard. And as per Schedule 6, if you are having any foreign currency monetary item for the depreciable fixed asset, then whatever the gain or loss is not transferred to P&L, but that gain or loss should be adjusted in the carrying amount of the fixed asset. That was the guidance under Schedule 6. But as per the accounting standard 11, whatever the gain or loss for related to any of the foreign currency monetary item should be transferred to P&L. So can I say this is a contradiction between the Schedule 6 and the accounting standard, and as per the rule, you have to follow the Schedule 6. But suddenly on 7th December 2006, this is the best date, NACAS, National Advisory Committee on Accounting Standard, has issued one notification on 7th December 2006. Now company will not follow the Schedule 6 requirement, but now companies are required to follow the requirement of Accounting Standard 11. And as per the Accounting Standard 11, whatever the foreign exchange gain or loss, that foreign exchange gain or loss should be transferred to statement of profit and loss. And luckily, in the year 2007-2008, dollar rate is reduced from $1.50 to $1.38. And if you are having the foreign currency borrowing, and if your dollar rate is reduced, can I say it is nothing but the foreign exchange gain for the company? So companies are happy, and now they are following the Accounting Standard 11 requirement. And as per the Accounting Standard 11 requirement, that gain should be credited to statement of profit and loss. And if we are crediting the foreign exchange gain or loss in our profit and loss, obviously my financial performance is increasing, and my company is disclosing the higher profit. But you know very well, every day is not same. Suddenly in the year 2008-2009, your dollar rate is increasing from $1 is equal to 38 to $1 is equal to 52. And now if you are having the foreign currency borrowing and the dollar rate is increasing, then it will be nothing but the foreign exchange loss for your company. And actually the rule is that you have to follow the Accounting Standard 11, and as per the Accounting Standard 11, this loss should be transferred to statement of the profit and loss. And if loss is debited to PML, Tata Steel company is making a losses. Airtel disclosed the loss of 800 crore. Actually, before recognizing this loss, the profit of the Reliance Industries Limited was 4,800 crore, but after recognizing the loss of 3,200 crore, they are disclosing their profit 1,600 crore. So every company has decided why we should follow the notification of NACAS. NACAS is just the body. What power is with NACAS? We are not following the NACAS and we will follow the Schedule 6 requirement. And now this loss is related to depreciable fixed asset, and that's why we are debiting this loss to the fixed asset. Now there is a big question mark on the existence of the NACAS, because when it was the gain in the year 2007 and 2008, people are recognizing the gain in the statement of profit and loss by respecting the NACAS notification. But in the next year, when there is a loss in the year 2008 and 2009, people are raising the question on the existence of the NACAS, and now people are not following the notification of NACAS, and now they are respecting the Schedule 6. NACAS cried, and he is now very angry, and NACAS introduced officially paragraph 46 or 46A in Accounting Standard 11 on 31st March 2009 by giving retrospective effect from the 7th December 2006. And that's why we have gone into the history. First time this introduced on 31st March 9, benefit is given up to 31st March 11. Again they have introduced this option on 31st March 11, and the benefit is given on 31st March 12. Again they are giving an option on 29 December 11, and the benefit is given up to 31st March 20. I already told you in this lecture only, if anything is suggested by NACAS, then it is only and only applicable to companies. For other than companies, ICAI has introduced para 46 or 46A in Accounting Standard 11 on 13th February 2014 retrospect. That is not relevant for you. Friends, please understand. Whenever this para was introduced, that para was optional. Means, if you want to follow the normal criteria of Accounting Standard 11, then whatever the gain or loss is transferred to PML. But para 46 or 46A is not mandatory, it's completely option. If you want to follow, you can, or if you don't want to follow, then it's okay. Most important this is that this is only applicable to the long-term foreign currency monetary item. If you are having any short-term foreign currency monetary item, then your para 46 or 46A option is not available. And what is the long-term? Long-term foreign currency monetary item is nothing but whose settlement is beyond the 12 months. And there are two options. If any foreign currency monetary item is related to depreciable fixed asset, then whatever the foreign exchange gain or loss, that foreign exchange gain or loss should not be transferred to PNL, but that foreign exchange gain or loss should be adjusted with the carrying amount of the asset. Obviously, if it is a loss, then it should be added in the carrying amount of the asset. But if it is a gain, then it should be deducted from the carrying amount of the asset. That's why I have written here, capitalization can be negative. And whatever the depreciation should be provided with the prospective effect, and it should not be provided with the retrospective effect. Clear? Next point. If any foreign currency monetary item is not related to for the purchase of the fixed asset, it is for the common purpose, then whatever the gain or loss, that gain or loss should be transferred to the one account called FCMITDA. And what is the full form of FCMITDA? Foreign Currency Monetary Item Translation Difference Account. And that account should be disclosed under the heading of the reserves and surplus. You should ensure that if you are following the para 46 or the 46A of Accounting Standard 11, then you are not supposed to follow the requirement of the para 4E of Accounting Standard 16. Whenever we are learning the Accounting Standard 16, I will explain you. But clear? Simple, if I speak the summary of this particular point, if any foreign currency monetary item is a short term, then para 46 or 46A benefit is not available. If it is a long term, but if you are not adopting the requirement of the para 46 or 46A, then simple loss is transferred to PNL. But if it is a long term and if you are following the para 46 or 46A, then you have to check whether that foreign currency monetary item is related to purchase of the depreciable fixed asset. If yes, then gain or loss should be adjusted in the carrying amount of the asset. But if it is for the other purpose, then it should be transferred to the FCMITD. Now, I am starting the discussion of the foreign currency operation. Friends, if you are in India, but if you are having any branch, subsidiary, associate or joint venture out of India, then it will be considered as a foreign exchange operation. You know very well, in India we are preparing the two financial statements. One is nothing but the stand-alone financial statement and second is nothing but the consolidated financial statement. If I am in India and my branch, subsidiary, associate or joint venture out of India, in India I have to prepare CFS. But problem is that my transaction in rupees, that transaction is not in rupees, that transaction in foreign currency. Let's say they are in US, then that transaction in US dollar. So I will demand trial balance from my foreign operation and I will convert that particular trial balance into the Indian rupees. Now you should ensure that as per accounting standard 11, there are two types of the foreign operation. Number one is nothing but the integral foreign operation and number two is nothing but the non-integral foreign operation. What is the meaning of the integral foreign operation? If some particular foreign operation is nothing but just an extension of the reporting entity, then it will be considered as an integral foreign operation. Best example is a branch. Branch is nothing but just an extension. What is a non-integral foreign operation? If any foreign operation is working independently, then it will be considered as a non-integral foreign operation. Best example is nothing but the subsidiary. If that particular foreign operation is integral, then simple fixed asset and the depreciation will be converted at a historical cost. Remaining assets or liabilities will be converted at a closing rate. If any income or expenses, then it will be converted at an average rate. Sometimes in the question they are not giving you an income and expenses, they are directly giving you a profit. So obviously if income and expenses converted at an average rate, your profit should be converted at an average rate only. If you are entering into any transaction with the head office, then simply it will be converted at an actual rate. Then finally, if you tally your trial balance, then your trial balance should not be matched. And whatever the difference, that difference will be considered as a gain or loss, and that gain or loss should be transferred to the P&L. But if it is a non-integral foreign operation, then simply all assets or liabilities will be converted at a closing rate. Income and expenses will be converted at an average rate. And if you are entering into any transaction with the head office, then simply it will be considered as converted at an actual rate. But yes, if you are having any foreign exchange gain or loss at the time of the translation of the trial balance, that gain or loss should be transferred into the FCTR called Foreign Currency Translation Reserve. Clear? Obviously, that FCTR will be transferred to the P&L whenever you are disposing your non-integral foreign operation. If you are disposing the entire foreign operation, the entire balance of the foreign currency translation reserve is transferred to P&L. But if you are not disposing the entire balance, then simply you have to transfer them on a proportionate basis. Clear? Now, let's discuss the forward contract. Friends, forward contract is nothing but an agreement between the two parties where one party agrees to buy from or sell to an underlying asset on a future date at an agreed price. Basically, there are two types of the forward contract. One is nothing but the hedging and number two is nothing but the speculation. In hedging, your purpose is basically the risk cover, but in speculation, your basic purpose is nothing but of the earning only. Whenever you are finding this contract is a hedging contract, you should find out the premium or discount. And the formula for the premium or discount is nothing but forward rate minus spot rate on the date of the forward contract. Whatever the premium or discount should be amortized in the contract term. Clear? And if it is a contract of the speculation, then you should not find out the premium or discount. Whatever the gain or loss at the time of the purchase or sale should be directly recognized in the P&L. Perfect? Now the next accounting standard is nothing but the accounting standard 12, accounting for the government grant. Friends, first of all, you should understand the meaning of the government. Friends, government is nothing but the central government, state government, local authority, national body, international body, and any other similar body including the private institution. Central government, state government like Gujarat government, local authority like Ahmedabad Municipal Corporation, national body like ICAI, international body WHO, UNESCO, and the private institution like Reliance Foundation and Adani Foundation. Then you have to understand the meaning of the grant. Friends, what is the meaning of the grant? Grant is nothing but anything received either in a cash or in a kind. For what? If you have fulfilled the condition or in past, or if you are fulfilling some conditions in the future, then it will be considered as a grant. And yes, most important is that value of the grant should be measured in reliably. If that amount is not measured in terms of money, then simply that particular thing is not considered as a grant. One thing should also be clear in your mind. If any tax holiday or if any tax exemption or if any government participation, then simply that will not be considered as a grant. Clear? Then how can we recognize the grant in our books of accounts? What are the recognition criteria? Friends, the recognition criteria is nothing but number one, the cost, number one, that is nothing but it is a certain that the grant will be received, and the number two, it is expected that you will fulfill your future conditions. Clear? Now forget every slides. If I directly discuss with you, there are basically two types of the grant. One is nothing but the non-monetary grant and second is nothing but the monetary grant. Non-monetary means something in kind and the monetary means something in the cash. If it is a non-monetary grant for the non-depreciable asset, then your entry should be asset account debit to capital reserve at a nominal amount, means at let's say 100 rupees. If any non-monetary grant for the depreciable asset, then your entry should be asset account debit to capital reserve again at a nominal amount. But if any non-monetary grant for the revenue purpose, then your entry should be asset account debit to P&L. Clear? Next, if I discuss, if it is a monetary grant for the non-depreciable asset, then you are having a two choice. You can adjust the amount of the grant with the cost of the asset, or the number two, you can adjust the amount of the grant or you can disclose the amount of the grant as a capital reserve. If any monetary grant for the depreciable asset, then again you are having a two choice. You can adjust the amount of the grant with the cost of the asset, and the number two, you can disclose that particular amount of the grant with the as a deferred government grant. And whatever the balance is accumulated in the deferred government grant, that balance of the deferred government grant should be transferred to P&L in the ratio of depreciation. If it is a monetary grant for the revenue purpose, then you are again having a two choice. Number one, amount of the grant will be adjusted from the expenses, and number two, it should be separately credited to P&L. Clear? Total 6 types of grant I have already covered. Number 7, if any grant is in the nature of the promoter's contribution, means if you are establishing your business in the backward area, and for that if you are receiving the grant, then it should be immediately credited to capital reserve. Number 8, if your company is receiving the bailout grant, and what is the meaning of the bailout grant? If your company is a public company or the government company and you are doing the work in the public interest, and if you are incurring the losses from so many years, then simply government will give you a grant from the bail of that particular losses. Simply that will be considered as a bailout grant, and that is always credited to P&L. Next topic, if I discuss, that is nothing but the refund of the grant. Friends, whenever you are not fulfilling any conditions, then simply you have to refund your grant. Just remember my one line. Refund of the grant will be considered as an extraordinary item as per the accounting standard 5. And whenever you are refunding of any grant, just remember my one rule: at the time of the receipt of the grant, whatever account was credited, at the time of the refund of the grant, same account is debited. Clear? Simply, there is no much more thing in accounting standard 12. Now, if we discuss the accounting standard 13, and the name of accounting standard 13 is nothing but the accounting for investment. You are having one chapter of the investment also. So simply, let's start with the investment. Friends, what is the meaning of investment? Investment is nothing but basically any asset held by income, held specifically for earning the dividend or interest or the rent or for the capital appreciation. But yes, stock will never and ever considered. Stock is never and ever considered as investment. Basically, there are two types of investment. Is nothing but the current investment, and second is nothing but the long-term investment. If any investment is acquired specifically for the purpose of sale within the 12 months from the date of purchase, then it will be considered as a current investment. And obviously, the other than the current investment, it will be considered as a long-term investment. If you are acquiring any land and building just with the intention to give that land and building on the rent or for the capital appreciation, then it will be considered as an investment property. Clear? Simply, friends, if I go ahead, how we will recognize the investment in books of accounts? Number 1, the cost of the investment should be measured reliably, and the number 2, it is expected that the future economic benefits will flow to the entity. If you are fulfilling the both conditions, you can recognize the investment in your books of accounts. And it will be recorded at purchase price, plus the taxes on purchase, plus legal expense, plus expenses on purchase. If there is any pre-acquisition dividend, then it should be deducted. And if this is a cum right share, then if you are selling the right, then again it will be deducted. Friends, every long-term investment is valued at cost. But every short-term investment is valued at a cost or fair value, whichever is lower. Friends, please understand what I am trying to convey. But if there is any permanent decrease in the value of the long-term investment, then again we will recognize the loss on the long-term investment. And how can we determine that? How can we determine the value of the investment? We will check the market price. We will check our investees. Means if I am a company and if I am investing the shares of the ABC, then ABC will be considered as an investee. Investees assets and the financial results, expected cash flow, that all thing we will consider. Clear? Friends, for the valuation of inventory, we are having the two method. One is nothing but the weighted average method and second is the FIFOs, exactly like accounting standard 2 only. And simply if nothing is given in the question, then my first priority is weighted average method. Clear? Okay. Next, if I consider, then simply, friends, please understand, just a minute. Okay, this is the most important point, reclassification of investment. You have acquired the investment for the more than 12 months, so it will be today long-term investment. But now you are transferring that long-term investment into the current. So whenever you are transferring the long-term investment into the current, what value you should transfer? Carrying amount or the or cost, whichever is lower. But whenever you are transferring from the current to long-term, you should transfer the cost or the fair value, whichever is lower. Friends, please understand long-term to current, cost or carrying amount, and the current to long-term, cost or fair value. In a both situation, it is a whichever is lower only. Clear? So finally, my accounting standard 13 ends here. And now if I start accounting standard 16, borrowing cost. Friends, what is the borrowing cost? Borrowing cost is nothing but the interest, commitment charges, amortization of discount and issue of debenture. Means the face value of the debenture is 100. And if I am issuing at 90 for the 5 years, so I am providing the discount of rupees 10. And that discount should be written off over the period of the 5 years. So every year I should write off the 2 rupees. So simple, that will be considered, and the cost of the maintaining loan. Friends, normally borrowing cost is charged to P&L. But if any borrowing cost is incurred specifically on the qualifying asset, then it should be capitalized. But what is the meaning of the qualifying asset? Friends, qualifying asset means any asset which take substantial period of time for ready to use. And what is the meaning of the substantial period of time? It is nothing but the 12 months or the more. Clear? Simply if I go ahead, then simply when we can capitalize the borrowing cost? Number one, if we are expecting that the qualifying asset will give the future economic benefit to the entity. And the number two, the cost of the qualifying asset is eligible for the capitalization. Clear? Friends, you know very well, basically there are two types of borrowing. One is called the specific borrowing and second is nothing but the general borrowing. Specific borrowings interest is directly capitalized to that particular asset only. But whenever we are making the borrowing from the various bank at a different rate, then it will be considered as a general borrowing. And for that we should find out the weighted average. But please remember one rule. Actually in a practical life we are borrowing from on the first day. But we are not doing the expenditure on the first day, we are doing the expenditure on a day-by-day basis. So whatever expenses we are incurring, basically we should find out the weighted average. And if we are having any temporary fund idle, and if we are investing that idle temporary fund, and if we are earning any of the income, then that income should not be credited to P&L. That income should be adjusted with the interest expense, and the net interest is capitalized. Clear? Next, if I consider, there are three topics that is called commencement of capitalization of the borrowing cost, suspension of the capitalization of the borrowing cost, and the cessation of the capitalization of the borrowing cost. When we can initiate the capitalization of the borrowing cost? First, borrowing cost is actually being incurred and the active development is taken place. But friends, understand that if because of any abnormal reason, if your work is stopped, then that for a particular time period you should not capitalize any of the borrowing costs, and that is called the suspension of capitalization. But you should understand that if any temporary delay, which is your necessary part of production process, then interest should be capitalized. Suspension of capitalization is not required. Clear? And the cessation, when your asset is ready to use or borrowing cost is actually not being incurred, in that situation we will not capitalize any of the borrowing costs. Clear? Now this para 4E. Number of Indian companies borrowing fund from outside India. And logic is that because the interest rate outside India is a very lower. So simply first step, you should calculate the interest expense if that particular amount is borrowed from the foreign country. In step 2, we will calculate the interest cost if amount borrowed in India. And in a step 3, we will calculate the foreign exchange loss. Friends, whatever the foreign exchange loss is actually not considered as a foreign exchange loss. The difference between the step 2 and the step 1 will be considered as the borrowing cost, and the remaining will be considered as a foreign exchange loss. If it's a foreign exchange gain, then simply it will not be applicable. And at the time of accounting standard 11, I told you, if you are following the para 4E of accounting standard 16, then you are not supposed to follow the para 46 or 46A of the accounting standard 11. Clear? So basically, I am completing my accounting standard portion, revision purpose for specifically for paper 1. Clear? Remaining chapters will be taken by the other faculties. Thank you friends. Thank you very much.
Hello friends, myself Professor Sudeep Shah, and you all are welcome to the Navkar Digital Institute. In the series of rapid revision in the intermediate group 1 accountancy, I am going to share with you the very important revision aspect of the topic. Number 1, insurance claim for loss of goods and loss of profit, and number 2, that is redemption of preference shares. Both the topics have been asked in the last examination. Out of 4 attempts, it was already there, that is of 3 attempts. So these are very interesting, having the weightage of 10 marks and 5 marks respectively. So without wasting much time, as it's a rapid revision, we are starting with the number 1, that is the topic named is insurance claim, that is for loss of goods and second is the word is loss of profit. So first part of the topic is loss of goods and second part is loss of profit. Friends, this is the topic based on the unfortunate event called the fire broke out in the business premises, and due to that if you can think out the prima facie loss that you can observe is the loss of goods. The goods lying unsold got disturbed due to the fire, and the second loss, that is the consequential loss, and that is nothing but the loss of profit as the business is disturbed, dislocated, and that requires some time to re-establish the business, and that all time will result into a loss of sale, and that loss of sale result into a loss of profit. Yes, in case of loss of goods, if you see the Navkar spiral, you may find 2 types of sums, that is of normal goods, and that is the, if I talk about the Navkar spiral, as this is the rapid revision, that we need to understand which sums are based on the which concept, and the point is very clear that classwork question number 1 to 4 are based on this concept, and normal and abnormal goods, normal and abnormal goods, on which there is a classwork question number 5 and 6 is based. So this is what the loss of goods is all about. If we talk about the loss of profit, then also I can divide it into 2 parts, that is calculation of loss of profit, that is the classwork sum number 7, 8 is based on the same, and last is the calculation of loss of profit with additional expenses, and that is the classwork sum number 9 and 10. So these 1 to 10 sums will make this topic complete, and that is the insurance claim for loss of goods and loss of profit. Now if I talk about the concept of the topic, as in this rapid revision we need to always touch the concept, and concept is very clear, and this is like this. The concept, if I can explain with the help of triangle, then yes, I can put in this way. The entire topic is synchronous in this triangle, and on the very bottom, left bottom of the triangle is nothing but the loss. Here is the risk, and here the most important is the policy value. What you have to remember, friends, if you want to get a claim, then be careful, your loss is nothing but a part of the risk. So your loss should not be compared with the policy. This is wrong. If you are comparing your loss with the policy value, then you are conceptually wrong. Yes, your risk should be compared with the policy value, then definitely you are right. If your risk is covered with the policy value, then it is absolutely right. In simple words, the loss is the part of the risk. If I put in the loss of goods language, then this is the goods which is destroyed, and risk is the goods which is lying unsold, and that is all capacity of all the goods to get destroyed, and that is called the risk. So you have to compare always the risk with the policy value and not with the loss. Yes, all the loss are the part of the risk. All the loss are the part of the risk. You cannot have a loss more than the risk, but yes, all risk are not part of the loss. All risk are not considered as a loss, but yes, all loss are the risk. So this triangle, or even we can say this is the circle that you always keep in mind. Okay, now to establish the table of this topic, that is the amount of claim, I will explain you with some small numericals. So in this case I am going to take first of all one table to explain you how to generate these numericals, and for that I need to prepare one table. Yes, the first column of the table is nothing but yes, I can say that it is the goods lying unsold, or I can say the closing stock. So first of all I need to give the serial numbers. And serial numbers 1 to 4, which can be the maximum possible situation, then closing stock, next is actual loss, and last is the amount of claim. Yes, this is the last one, which is based on the amount of claim. Okay, so if I give the title now, serial number, closing stock, actual loss, and last and most important, that is amount of claim. So the situation is like this. For example, we take a base of closing stocks to derive the concept, and concept is very clear, that for example business has taken the policy for goods, that is for example say it is 8 lakhs. As business is having the maximum level of stock is 8 lakhs, so he has taken the policy of 8 lakhs. For example, case 1, the date of fire on which business premise having a goods of 5 lakh unsold, and that is the closing stock we will put. This is the stock on the date of fire. You can see that the stock is of 5 lakh, but the policy is of 8 lakhs. So we can say that yes, business is fully insured. Yes, if the entire stock is destroyed, then your actual loss is also 5 lakh. But as you are fully insured, because your closing stock, in another word risk, is covered with the policy value, so your amount of claim is also 5 lakh. So you can see that there is a amount of claim which is equals to the actual loss, the reason you are fully insured. So this is the case 1, friends. If I go with the case 2, then it can be like this. 5 lakh stock, policy value is 8 lakhs as always, but as businessman comes to know there is a fire in the business premise, he rushed to the premise and managed to survive the goods of 2 lakhs. So his actual loss is 3 lakhs only. But as his policy is more than the risk, here I am talking about the stock, not the actual loss. I am talking about the 5 lakhs. If the policy is more than the risk, this is always considered as a risk, my dear friends, and this is considered as a loss. So you can see that the policy is not more than loss, but even more than risk. So business is again fully insured. So again you will get the actual loss reimbursed, and that is what we can say the amount of claim equals to actual loss. So this is the second case. Now if I move to the third case, Then I make some changes in the policy value now. For example, now the policy value is only 3 lakhs. Again, the stock on the date of fire will remain unchanged, that is 5 lakhs in any case. The entire stock destroyed, that is also actual loss is also 5 lakhs, but you can see that the policy is only 3 lakhs. So we can conclude that business is under insured, and because of this under insured and entire loss is destroyed, entire goods are destroyed, so you can get maximum amount, that is up to the policy value only, and here the policy value is only 3 lakhs. So our amount of claim will be only 3 lakhs, and that is maximum up to the policy value. And the fourth case, that is the last case, where the policy value is 3 lakhs, but we will keep the goods as 5 lakhs. As always, on the date of fire, the goods lying unsold is of 5 lakh, the policy value is 3 lakhs. So again, once again we can say that business is under insured, and in such case you will never get your actual loss reimbursed. And businessman managed to survive the goods of 2 lakhs, so his actual loss is 3 lakhs. But you can see that the loss is 3 lakhs, but policy is only of 3 lakhs, but which do not cover the risk. It is very important concept, friends. Risk should be covered with the policy and not the loss. This is the goods destroyed, and that is loss should not be compared with the policy, but goods lying unsold have all potential to get destroyed, so it should be compared. So here the business is under insured, but here the average clause will be applied. Yes friends, so here the average clause will be applied, and where average clause formula is very clear, actual loss, yes, that is actual loss into policy value upon risk. Here risk is nothing but the closing stock. So we can say that actual loss is 3 lakhs, policy is also for 3 lakhs, but risk is of 5 lakhs. So we can say that the business is only 60% insured. You can take a percentage of this, you may find it is 60%. So 3 lakh which is multiplied by 60% give you 1,80,000, that is the amount of claim that can be given. So here the value is not 3 lakhs but 1,80,000. The reason 3 lakhs will be given only when you are having the total loss, but if you have a partial loss, then you will be allowed a proportionate amount. So on the basis of these all calculation, we can prepare the table which help us to understand the entire topic thoroughly, and for that I am preparing the table. Yes, there will be first for that is insurance and other for that is loss. Yes, the table that is for amount of claim. First of all, the topic will emerge only when there is loss as well as there is an insurance. Loss can be of two types, total loss and partial loss. But in case of insurance, there can be of two types, fully insured partly insured, or we can even use the word under insured. Yes, this is the right word. Okay, business is said to be fully insured when the policy is greater than risk. Yes, that we need to write policy value is greater than equals to risk. But when policy is less than risk, business is said to be under insured. So in this case, as business is fully insured in the first column, the amount of claim is always equals to actual loss. You will get your actual loss reimbursed whether it's a total loss or a partial loss. But yes, when you are underinsured and there is a total loss, you will get maximum up to policy value, which also known as the sum insured, and underinsured with the partial loss will be calculated as per the average clause, and formula is already written, and this is what I want to convey you friend. That is, yes, now you can see that in first two cases, in these two cases, as you can say that the policy value is more than the risk. Be careful, I am comparing it with not the loss but with the risk, and so that here we can say that the amount of claim equals to actual loss. But in the remaining two cases, these two, the policy value is not equals to the risk, or risk is greater than policy value, so business is said to be underinsured, and here you will never find that actual will be becomes the amount of claim, but it will be as per policy value or as per average clause. So friend, this is the table that you have to apply in any case, whether it's a loss of goods or even a loss of profit. You can apply this table, and with the help of table you can definitely manage to get the answer. So this is what the revision aspect cover this concept. Now in case of that is in loss of goods, your risk is nothing but the most important thing is to calculate the risk. The reason, policy value will be always given in a question, and when you compare the risk with the policy value, you can judge whether it is fully insured or underinsured, and on the basis of that judgment you can get your actual loss reimbursed or not. So now the question arises, how to calculate the risk. So in case of loss of goods, risk is nothing but the goods lying unsold on the business premise. Be careful, it is not the goods which is destroyed, but the goods which is unsold in the business premises should be considered, and for that you need to prepare the memorandum trading account. Yes, this is what I am going to explain you now. This is will help you to arrive the closing stock, and for that you have to prepare the memorandum trading account, and that memorandum trading account is nothing but a normal trading account that we are normally prepares, and for that, yes, and for that you need to just prepare the trading account. On the both the side, the column is obviously amount, yes. Now if I give the title, that is memorandum trading account, that is prepared from the opening date of accounting up to the date of fire, that is opening date of accounting year, that is up to the date of fire. Memorandum trading account up to the date of fire. So particulars, amount, particulars, amount. Yes friends, your destiny is to arrive at this part, that is the closing stock, that you always need to calculate, and that is the most important part of your study, and that is nothing but the risk. And for that, the opening stock that is given in the question, that is the closing stock of last accounting year, that is added with the purchase up to the date of fire less purchase return, that is to be placed over here. Apart from that, any purchase expenses, sales deducted with sales return is shown over here, and goods goes other than sale can be also credited. Now the most important part is to apply the GP, that is on the basis of sales. This GPR will be provided either in the question, or you have to arrive the same by calculating the GPR of the last year and put over here, keeping it as a constant. So GPR यहाँ रखने से ही आपको पता चल जाएगा कि yes, we can have a GP of this much amount. So this is the balancing figure friends, and that is nothing but the risk of the business, and once you arrive to this risk, the story is almost over. As you have all the 5 figures with you, the remaining, we can definitely calculate the remaining last figure as a balancing figure, and comparing this risk with the policy value, you need to compare the same. And when you compare the same with the policy value, you can judge whether business is fully insured or not. And if risk, or I can say the policy value, is higher than the risk, then business is said to be fully insured. But if risk is higher than policy value, then business is said to be under insured. And by that, by arriving this judgment, you have to just apply the table. It may happen that you may find a new GPR, so you need to calculate the new over here. Even you may find some complication in opening stock, purchase, sales, then you have to adjust all the adjustments, but the ultimate point is to arrive this closing stock. Okay, sometime you find some abnormality in the stock, so in this case you have to prepare some more columns, and you can bifurcate this amount column into two parts, that is normal and abnormal. Yes, you can bifurcate the same with the normal and abnormal. Yes, you can here bifurcate, where the first column can be considered as a normal, second is abnormal, same over here, normal and abnormal. So this is what may be the maximum scope of the topic, and that is regarding the loss of goods. So our destiny, our purpose, our aim is to arrive this value, and that is the closing stock. And once we reach to this point, we are almost on the verge of completion. The reason we find the risk involved, and by arriving the risk, comparing it with the policy value, yes, we can definitely get the answer. So this is, friend, the loss of goods that I have explained you, that is with all concept. First of all, this is the chart showing you the which sum is based on which concept. Then this is the triangle which is the center part of the topic, that risk should be covered with the policy value and not the loss. All loss are risk, but all risk are not loss. Number 3, if you are fully insured, then amount of claim equals to actual loss. And number 4, insurance company always reimburse you with the current cost. So these 4 aspects that you have to keep in mind. With these numericals, I have created one table, and that table will help you to solve any sum of the topic. The reason, the topic can start only when there is an insurance and there is a loss taken place due to fire, and in both this case there are only 4 possibilities happens, whether it's a fully insured, under insured, total loss or partial loss. Only these 4 possibilities happens, and to arrive the risk we need to prepare the memorandum trading account, and that what I have prepared here, and that you need to keep in mind. So now if I talk about the second part, that is of the topic, in which is nothing but the loss of profit. So in that case you have to just follow the 6 step maximum. Normally it is 1 to 5, and in some cases the up to step 6. Step 1 is nothing but we need to arrive first of all, that is the loss, and loss of profit is based on the loss of sale, and that is we known as the short sales. And that short sales can be derived by comparing the sales of the disturbance period, and that is of the corresponding period. And so the steps are very simple. Sales of corresponding period, that is sales of corresponding period of last year. Yes, this is adjusted with add oblique less change in trend. That is nothing but the question will help you to prove that change, and that is already given in a question, that is either it may be upward or even may be downward. That is compared to the past year, the growth that business have established, and that is to be placed over here, which can be directly given in terms of percentage, or it can be given with the help of the figures, that is belongs to the pre-fire period, and that is to be compared with the past year. So by applying the same, you will definitely get the standard sales. So these can be the sales which we can anticipate in that period of disturbance, but the actual sale of disturbance period we need to compare it, that is sales of actual disturbance period. That is the sales of actual disturbance period. We need to compare it, which is definitely lower than the standard sale. So the balancing figure is nothing but called as a short sales. Yes, this is the step 1. The reason to arrive the loss of profit, first of all we need to arrive the loss of sale, and that is known as the short sales. Now the question arises, sir, on this short sales what profit we can manage to gain and which we have lost. So to arrive that profit we need to have a profit margin which is called a gross profit ratio. That gross profit ratio we need to calculate, and that is here step 2. GPR equals to net profit, yes, plus insured standing expenses. Yes, this is the expense even though business caught in fire we need to incur, and if it is insured then we need to consider as a insured standing charges, and even if it is question is silent then also we need to consider as a insured, divided with the sales of last financial year into 100. So this is what the GPR we can arrive. Be careful in this case when the standing expense is given in a question but no information regarding its insurance, we need to assume that they are fully insured. Same way in case of short sales we need to consider that is the indemnity period or disturbance period. That is whichever is lower, that we need to consider. If your indemnity period is 4 months and disturbance period is 6 months, then you are allowed to calculate only for 4 months, because you have only keep your business guarded with 4 months. But yes, if your indemnity period is 4 months but disturbance is only for 3 months, then you have to go with the 3 months. The reason you will never get the amount more than what is actually lost. So this is step 1. Now the step 2 is nothing but the gross profit ratio, that is based on the previous year data, needs to be adjusted with the change of GPR given in a question. So this is what the final answer, and that is the latest GPR. Normally it is given that 5% GPR is increased due to the rise in the sale price, or 2% GPR decrease due to the increased cost of production. Now the step 3, which is the interesting step, and that is nothing but the actual loss. And the actual loss, that is the amount which can be reimbursed or not, that we need to calculate with the help of step 4 and 5. So here actual loss is nothing but short sales that we have calculated in step 1 multiply with GPR that we have calculated in step 2. So yes, step 1 multiply with the step 2, we can have an actual loss, and that amount can be reimbursed only when business is fully insured. So to judge whether business is fully insured or not, we need to have a calculation of risk, and that will be in the step 4, that is nothing but the yearly profit. But to arrive the yearly profit, we need to have a yearly sale, and the title is adjusted annual turnover. So adjusted annual turnover is the step 4, very interesting, and here we need to take that turnover which is the latest one, and in that case sales of 12 months immediately preceding the date of fire is to be considered. But yes, some portion of these 12 months may fall in the previous year, and if the question says that there is a rise or there is a growth which witnessed in the current year, then that should be adjusted. Here it can be upward or downward, both the side. Change in trend, this is friend the same percentage that we have applied in step 1 should be applied over here. So by applying the same, we can have the adjusted annual turnover, and that is the step number 4. Now we reach to the final step, and that is step 5, which is have a different names in the different book, which is popularly known as yearly profit, which is your risk which can be disturbed, or GP on AT, or even the insurance coverage required. You may find different names in the different books, so these are nothing but the name of the step 5. We will use the word yearly profit, which is nothing but the risk. The profit which have all potential to get disturbed is called a risk, and yearly profit is nothing but the adjusted annual turnover that we have calculated in step 4, multiply with the GPR, that is in step 2. So we can get the yearly profit. This yearly profit should be compared with the policy value. So I can give the note over here. If yearly profit, that is nothing but the risk calculated above, is equals to or less than policy value, then business insurance policy is considered as fully insured policy. So amount of claim equals to actual loss. But if yearly profit is more than policy value, then business insurance policy is considered as underinsured. So amount of claim as per average clause, where friend average clause equals to actual loss into policy value upon risk, but here the risk is not closing stock but the yearly profit. So friends, we have two only options, either fully insured or underinsured. If it is fully insured, then the story is simple, we need to just calculate the amount of claim equals to actual loss. But yes, if business is underinsured, then we need to apply the average clause. So now if I talk about the last step, that is step 6, which can be applied only when there is information regarding additional expense. So the name of the step 6, allowable additional expense. Be careful friends, this step you need to calculate only when the question is talking about some additional expense incurred. So here what is allowed? So number 1, actual additional expense. Yes, you cannot get anything more than the actual additional expense, that is number 1. Number 2, due to this expense, what the benefit you pass on to the insurance company, that is calculated on the basis of GP on increased turnover. That is what you need to consider. If the question is silent about the increment in the turnover due to this expense, then you need to consider all the turnover of the disturbance period as the increased turnover. And third is nothing but if all your standing expenses are not insured, then this is also a nature of standing expense, this additional expense. So you need to calculate the proportionate amount, and that is actual additional expense. We need to now make it proportionate into net profit plus insured standing expense upon net profit plus total standing expense. Yes, and out of this, whichever is lower is allowed. So out of these 3 answers, you need to consider whichever is lower. Be careful, here you will find many other formulas even in the ICI modules. Yes, here you may find many formulas. So you have not to worry, you can apply any formula. I have used such formula which is very easy to learn, but in applying the other formula you may find some change in the answer but all answers are accepted, as we have a different that is the talk plan in the different that is telecommunication company. The same way here you may find difference of the formula in that is applied by the different insurance company, but you have not to worry, you can adopt any formula. Yes, there may be a minor difference in the answer, but all are valid. So this step 6 will be considered only when there is a allowable additional expense, and which is ultimately added to this actual loss as we have calculated in the step 3. And yes, by applying such actual loss with the allowable additional expense and arriving the judgment whether business is fully insured or not, you can get the final answer. So friends, this is the rapid revision of the topic insurance claim for loss of goods and loss of profit. I am sure this will help you to revise the topic on the very early days of your examination, and that can give you all 10 marks. Thank you friends. This is the topic insurance claim, which is popularly known as a fire claim. Thank you. Yes friends, in this rapid revision series, now we are going to understand the topic which is the redemption of preference shares. Yes, this is the topic which can have only 5 to 7, 8 entries and can give you all 5 marks. That is redemption of preference shares. Yes, if I start with the very zero level, the capital of the company is broadly classified into 2 parts, and that is number 1 owner's capital, and that is number 2, that is a borrowed capital. Yes, in case of owner's capital, you may find the main source is the shares. Yes, in the borrowed capital, the main source is debentures, if I talk on a very large scale. Yes, in case of shares, that is also divided into 2 parts. Number 1, that is equity shares and preference shares. Yes, equity shares are never redeemed in the life as they are the owners, but yes, preference shares are redeemable, and we are concentrating on this part friends, that we need to understand in the intermediate. In case of equity, there can be a buyback. In case of debenture, there is a redemption, and the same thing with the preference shares, which can be redeemed within a maximum period of, say, that is 20 years. But in case of infrastructure and other specified company, that is for 30 years. So the provision regarding redemption of preference shares, that is explained in the section, that is provision of redemption of preference shares, is explained under the section 55 of the Companies Act 2013, and we need to understand only 3 provision if I give you a rapid revision for the same. Number 1, only those preference shares can be redeemed which are fully paid up. So it must be fully paid up, then only it can be redeemed. So here I would like to discuss something. If the question in which there is one type of preference share which are fully paid up, then there is no need to worry, you can definitely redeem the same. But if there is only one type of preference share which is partly paid up, then you have to go for a call and you need to make it fully paid up. Now the question arises, if there are 2 types of preference shares given in a question, one is fully paid up and another is partly paid up, then only you need to go with the fully paid up preference shares. You have not to make the second, that is partly paid up shares, to make it a fully paid up. You have to just proceed with the fully paid up shares, nothing to do with the partly paid up shares. So it is very simple friends. If you find one share which is fully paid up, no issue. One share that is partly paid up, then you need to make it fully paid up, assuming that final call is demanded and received. But if there are 2 types of preference share which is fully paid up, number 1, and number 2 is a partly paid up, then you have to only consider which is fully paid up, and you need to proceed with that type of share only. You have nothing to do with the partly paid up shares. Second provision, replacement of preference share capital. And for this replacement, you have 3 options with you. Yes, the 3 options are: Okay, these are the three options I can explain you. Yes, number one, that is fresh issue of shares. Fresh issue of shares. Be careful, here I have not used the word debentures, cannot be used. To redeem the existing preference shares, you can go with the fresh issue of shares. It can be even equity or preference shares, any, or by transferring free reserves into the account called capital redemption reserve account. Yes, the second option is with the companies to transfer their free reserve into the one account which is very important, and that is the capital redemption reserve account. You have to transfer the amount equivalent to the replacement of preference share capital, and that is the nominal value, which can be considered as even a face value. So this is the second option, this is the first option, and the third option is a combination of both. You can go with first or two, or you can go with the both, that is or and are the third option. So you can get a combination of both. For some portion you can issue the fresh shares, or for the remaining you can utilize the free reserve. But be careful, only those company can go for a free reserves who are having the enough liquidity. With them to repay the preference holders. But if companies finding some liquidity crisis, then they will definitely go with the liquidity crisis, then company will definitely go with the issue of fresh shares. So this is what you need to keep in mind. And yes, some liquidity is with the company and they can wants to generate the additional liquidity, then can go for a both, that is the fresh issue as well as the creation of CRR. The third and the last is, if company wants to redeem the preference share with premium, that is premium on redemption of preference shares, can be utilized only out of the securities premium available, that is security premium available with the company. That was the earlier, but nowadays as per section 133, company cannot use the securities premium, but only profit and loss account available before such redemption. So now the question arises, sir, how we can comes to know that the company which is given in a question is governed by section 133, the section which is applies to those companies for whom they need to comply their financial statement with the accounting standards. So it is clearly written in the ICA module that in the absence of any information, you have to assume that the companies refers into the question is governed by the section 133, and so that now you cannot apply the securities premium for the purpose of redemption of preference shares, or so for the purpose of premium on redemption of preference share, but only the P&L account. So the point is that now you cannot use the security premium account, but only you have to use the profit available before such redemption. So now it's time to understand which are called the free reserves. And the list of the free reserves, the following are the free reserves. The definition of free reserve is very clear, friends. The profit which is otherwise available for distribution of dividend is called a free reserves. I repeat, the profit which is otherwise available for a distribution of dividend is a free reserves. So list is number 1, simple profit and loss account. Number 2, general reserve. Number 3, workers accident compensation fund. 4th, that is investment fluctuation funds. Here no claim we assumed, here no fluctuation we assume. And the last is nothing but the dividend equalization fund. So these are the friends free reserves that you need to always consider, and that is the amount which can be transferred to CRR, and following are not considered as a free reserve as it's a capital profit. So here also you need to have a list of the same which are not considered as a free reserves. Number 1, securities premium. Number 2, that is capital reserve. Number 3, that is profit prior to incorporation. Number 4, even share forfeiture account. And number 5 is development rebate reserve. So friend, this is the list which is not a free reserve, you cannot transfer to the CRR, and this is the list which is considered as a free reserve and which can easily transfer to the CRR. Yes, it can be transferred to CRR, and here it cannot be transferred. As these are the not a free reserves. So this is the second condition that you need to keep in mind, that only free reserves which are otherwise available for dividend can only be transferred to the CRR. So here you can see that by just following these simple 3 provisions you can definitely get all 5 to 7 marks, but be careful, this P&L we can use in both the cases. Here you can see that is for the creation of CRR and that is also to write off the redemption premium. So be careful, the P&L should be first used to write off the premium on redemption, and balance if any should be transferred to CRR. Then you may have a question, and then sir, if the CRR is not sufficient, then you have always option to go with the fresh issue. But in case of redemption of preference share with premium, you don't have the option other than P&L. So I repeat, the P&L should be first used to write off the premium on redemption of preference share, and the balance if any can be used for the creation of CRR, and if the CRR is not sufficient you can go with the fresh issue of shares. So now it's time to understand all the entries friends. There are maximum 7 entries that we need to understand, that is the journal entries for redemption of preference shares. We'll write case by case. So first case is when final call made to make partly preference shares into the fully paid preference shares. Here the partly paid preference share into the fully paid preference shares. So entry is very clear, say friends, preference share final call account debit to preference share capital account, and when the final call money is received, when final call received on preference shares, the entry is very simple, bank account debit to preference share final call account. So this is the entry that I have passed to make it fully paid up. Now once it becomes a fully paid up, then you can redeem the same, and for that you can issue the fresh shares. The entry is very simple, when fresh shares are issued, for redemption of preference share, then entry is very simple. If I make a compound entry, bank account debit to preference or even equity share capital. And if it is issued with premium, then you can also credit securities premium account if any. So this is the entry, friends, for making the fresh issue at the time of redemption of preference shares. Yes, and the next entry is regarding the free reserve to be transferred to the that is to the capital redemption reserve, and for that the title is when free reserves are transferred to CRR. So entry is very clear, friends. All free reserves, that is, it may be P&L account debit, general reserve account debit, workers accident compensation fund account debit, investment fluctuation fund account debit, even dividend equalization fund account debit to CRR account. That is the entry that we need to pass when we go with the second option. Now it's time to make the preference share ready, but before, be careful, if it is issued or rather redeemed with premium, then entry for when redemption premium written off against profit and loss account. So entry is, the next entry is fifth number entry. Yes, the fifth entry is P&L account debit to premium on redemption of preference share account. So this is what you need to pass. Now it's time to redeem the preference shares. So when preference shares are ready to be redeemed, so entry is very clear, friends. Preference share capital account debit, you can even add the percentage. Preference share capital account debit, if premium on the same, premium on redemption of preference share account debit to preference shareholders account. And when actually it is redeemed, yes, so when actually preference shares are paid, so when preference share capital redeemed, then the entry is very simple, friends, that preference shareholders account debit to bank account, and that is the seventh entry, friends. Yes, friends, the additional two entry we can pass for the usage of CRR, and that is always used for the issue of bonus shares. Yes, so when bonus shares declared out of, rather the word is out of, CRR account, then the entry is very simple. CRR account debit to bonus to shareholders, bonus to equity shareholders, and when bonus shares issued, this is the entry number 8th, when bonus shares issued to equity shareholders, then the last entry that can be passed is bonus to equity shareholders account debit to equity share capital account. So friend, these are the entries that you need to understand while solving the sum. The first entry is nothing but to make the partly paid up preference share into fully paid up, which is the precondition as I have explained you in the very beginning. Second is when the call is received, now it's a fully paid up, then bank to preference share final call. Okay, now when fresh shares are issued out of for the redemption of preference shares, so very simple entry, bank to preference or equity share capital to securities premium if any, as now the discount is not allowed. Okay, when free reserves are transferred to CRR, all the reserves which are free debited to CRR, and when the redemption premium is written off against the P&L, the P&L account debit to premium on redemption of preference shares. Okay, when preference shares are ready to redeemed, so now it's time to debit the preference share capital, and even the premium if any should be also debited. This is if any to preference shareholders account, and when it is actually redeemed, preference shareholders account debit to bank. Okay, now two additional entry, when the CRR account is used to issue the fully paid up bonus shares, then the entry is CRR account debit to bonus to equity shareholders, and when it is actually issued, bonus to equity shareholders account debit to equity share capital account. So friends, this is what the quick revision of the redemption of preference share. In the examination you need to pass these entries and you need to prepare the new balance sheet after the redemption. But in this regard you have to be clear about the 5 points. Number 1, if the question gives about the partly paid up preference share which is only one, then you need to make it fully paid up, then only you can redeem the same. But if there are two types of preference shares, which is one fully paid up and another is partly paid up, then you have to make redemption only of fully paid up and you have nothing to do with the partly paid up shares. Case 2, as I have explained you, a company facing a liquidity crisis will always go for a fresh issue of share so that they can have both the purpose solved. Number 1, provisions requirement are fulfilled and even the liquidity emerged. And second is when the company is enough liquidity and they have free reserves available in their balance sheet, so it can be easily directly transferred to the capital redemption reserve. But in some case you will find the combination of these two, and that is for some part fresh issue are issued, shares are issued, and for the remaining portion CRR account is created, and mostly you will find such type of sum. Third is when the company wants to redeem the preference shares with premium, then in such case such premium on redemption of preference share is a loss for a company, and it should be written off only against P&L as per the latest provision given under section 133. Be careful about this number. Yes. Now the question arises, sir, how to judge that the company given in a question is governed by section 133? The simple answer is that if nothing is mentioned, you have to consider that company given in a question is governed by section 133, and you have to put a note for the same, and so that you cannot use the securities premium account for the redemption of that is for the premium on redemption of preference share, but only the P&L account. So once again there is always a question in the mind of the student, sir, this P&L can be used both the purpose, that is number 1 for the redemption premium and number 2 for the creation of CRR. So if we have a very limited balance in P&L, then what to do? The answer is very simple. First of all, you need to use it for the writing of premium and redemption, and balance if any should be transferred to CRR. Now the question arises, if CRR is not sufficient to replace the capital, then you can go for a fresh issue of shares, and that is the second alternative always available. But in this case you don't have a other alternative to write off the premium on redemption of preference share, and the only alternative is P&L account. So list of free reserves which are available and the list of the free reserve which are not available for transfer to CRR, and you can have this list. This is very exhaustive list. Almost you will not find the reserves other than this in the examination. And then we have covered all the journal entries of the topic, and that is maximum 7 to 9 entries that you need to understand or you need to memorize while solving the sum. And every journal entry have their own that is the situation that I have already mentioned on the very top. For example, in this case when final call is made to make it fully paid up to partly paid up into fully paid up, this is the entry for the same. Second is when the call is demanded for the same and which is received, then you have to pass such entry. Third is when fresh shares option what company avails, then what to do. The entry is very simple if it is issued at a premium, and when the free reserves are transferred to the CRR, that is the second option available with the company, he is also explained you. Now it's time to write up the redemption premium against the P&L account, and for that you can now only use the P&L. Earlier the securities premium can be also used, but now it is not allowed as per section 133. So next entry is when preference shares are ready to be redeemed, then debit the preference share capital, debit the premium as it is expense for the business, and credit is given to the preference shareholders. And when the actual preference capitals are redeemed, then the credit given to preference shareholders, now it is repaid through the bank. The last two entries is regarding, friends, when bonus shares are declared out of CRR, so that against this general reserve can be transferred into the capital, and that is what the entry is passed. And the last is regarding, yes, that is what when actually bonus shares are issued, and that is the entry regarding the issue of the bonus shares. So friends, these are the 9 entries that you need to keep in mind while solving the sum, and I am sure with the help of these 9 entries you can solve any sum of the topic. So this is what the redemption of preference shares, friends. I have explained you the 2 topics, very interesting. That is number 1, insurance claim for loss of goods and loss of profit. The second is the redemption of preference shares. Thank you, friends.
Okay, now let's start with the next chapter, that is hire purchase, revision of hire purchase. In a hire purchase, first of all you need to understand how to calculate the interest in case sometimes cash price is not given in the question, sometimes cash price is given, rate of interest is not provided in the question, and sometimes cash price as well as rate of interest is not provided. So we have done similar type of questions, different type of questions in the classwork section, and mainly in the exam they ask questions based on reposition of goods. And for reposition of goods you need to understand how to prepare that interest table. This for example, this is the table, interest table. So how to prepare this interest table? We have done almost 12-13 type of different table related questions, and preparation of table when different situations where cash price not given, reverse calculations, and etc. Different questions we have done. And thereafter for reposition questions you need to understand questions based on, you need to understand the journal entries in the books of purchaser and the books of vendor. Similar type of again reposition questions we have done. Classwork question number 14, classwork question number 15, and homework, almost all questions are based on reposition of goods. So we have covered all the questions in classroom itself regarding reposition. So you just need to understand the basic entries, preparation of table, and that's it. The only that thing you need to remember. And the similar type of questions are there, like in reposition of goods you need to understand the similar one question you understand how to prepare the account and etc. Similar type of questions are there in total reposition related questions. So before I'm just going to explain you one question regarding reposition of goods. Almost the whole chapter is related to this similar type of questions are there in the whole of the chapter. So before starting with the question, just first revising the journal entries in the books of purchaser and the books of vendor, because these entries are very important. If you understand the entry, then only you can prepare the accounts. In exams, reposition accounts are normally asked in the books of purchaser and the books of vendor. So for that purpose, let's start with the journal entries first. In the journal entries in the books of vendor, first of all in the books of purchaser. In the books of purchaser, normally 6 entries are passed. The first entry for asset purchase entry will be asset to vendor. In the books of purchaser I'm talking about purchaser books. So first entry for asset purchase entry will be asset to vendor. Second, for down payment entry will be vendor to cash. For down payment entry will be vendor to cash. Then after, when interest becomes due, entry will be interest to vendor. Then after, when installment is paid, entry is vendor to cash. And then after, debris provided, debris to asset. And last one, to transfer debris and interest to P&L account, entry P&L to debris to interest. Total 6 entries are passed. Again, just revising the entry. Again, repeating in the books of purchaser, just the heading of 6 entries. The first one will be for asset purchase, second for down payment, then after interest due, then fourth installment payment, then after debris provided, and last one transfer to P&L. The 6 entries you need to pass. Again, with entry I am repeating. The first one for asset purchase, asset to vendor, then down payment, vendor to cash, and after interest due, interest to vendor, installment payment, vendor to cash, then after debris provide, debris to asset, and then after transfer debris interest to P&L, P&L to debris to interest. Same entries to be passed in the books of vendor. These were in the books of purchase and now in the books of vendor. In the books of vendor, out of these 6 entries, the same 5 entries to be repeated except depreciation entry. The remaining 5 entries are to be passed in the books of vendor. The first one will be in the books of vendor, the first entry for sales. Sales entry will be purchaser to HP sales. The sales entry will be purchaser to HP sales. Thereafter, for down payment, entry will be cash to purchaser. Then after, for interest due, purchaser to interest. Then after, for installment receive, cash to purchaser. And last one to transfer interest to P&L, entry interest to P&L account. Again repeating, first one for sale entry, purchaser to HP sale. Then after, down payment, cash to purchaser, interest due, purchaser to interest, installment receive, cash to purchaser. Debris entry will not be provided in the books of vendor. And last one to transfer interest to P&L, entry interest to P&L account. So these are the entries to be passed in the books of purchaser and in the books of vendor. Now let's take one example. Then similar type of questions are there in repossession. Let's take one example. So question is, Lucky bought 2 tractors from Happy on 1st October on the following terms. Lucky is a purchaser here and Happy is a vendor. On 1st October, Lucky purchased 2 tractors. There are 2 tractors, 2 assets purchased. Down payment is given rupees 5 lakh. The first installment amount given, second installment given, third installment values are given. So cash price is not provided. Down payment and 3 installments are given. Cash price is not there. Interest rate is given 10%. And Lucky provide depreciation. Depreciation rate is 20% as per diminishing balance method, meaning WDE method. Lucky is a purchaser. He provide depreciation 20% on WDE method. On 30th September, Lucky failed to pay the third installment. The first and second installment is paid, but failed to pay the third installment. Whereupon Happy repossessed 1 tractor. Only 1 tractor repossessed out of 2 tractors. Both are not repossessed. First tractor, 1 tractor is repossessed. Happy agreed to leave 1 tractor with the Lucky, adjusted the value of the other tractor against the amount due. The Happy repossessed 1 tractor and the amount was adjusted against the amount due. The tractor taken over was valued on the basis of 30% depreciation. So this sentence is very important. The tractor taken over valued on the basis of 30% depreciation annually on WDE method. The tractor was repossessed at 30% depreciation. And the balance amount remaining up in the vendor account after the above adjustment was paid by Lucky after 3 months with interest of 18%. The remaining amount is to be paid after repossession. There will be a closing balance, and that balance is to be paid after 3 months with interest of 18%. In question, you are required to find out first cash price by preparing the table and prepare tractor account, meaning asset account and Happy account in the books of Lucky. Lucky is a purchaser. So in the books of purchaser, we are required to prepare 2 accounts, asset account and vendor account. These 2 accounts are required to be prepared. And question is basically, after reading, we understand that question is regarding repossession of goods. So in repossession of goods, there are 2 types of questions possible. In repossession of goods, one question is regarding when repossession value is given in the question, and the another question type is when repossession value is not given in the question. 2 types of questions possible in repossession. Either repossession value will be provided or repossession value will not be provided. Whenever this sentence is provided given in the question, this sentence, the tractor taken over valued on the basis of 30% depreciation as per WDE. Tractor taken over meaning asset taken over were valued at this much depreciation. This is value of calculation of asset taken over, meaning this depreciation rate is given to calculate the repossession value. This is not the actually depreciation rate. Depreciation rate is actually 20%, which is provided by purchaser. Purchaser is Lucky. So depreciation rate is actually 20%. Then why 30% is given? The 30% is that rate is given to calculate the repossession value. So to calculate repossession value, normally that repossession rate of depreciation will be provided to you. When repossession rate is not provided, then that question will be a question type where repossession rate is not given or repossession value is not given. In this question, whenever you find 2 types of depreciation rate, one will be depreciation, actual depreciation, which will be provided by purchaser, and the another one will be repossession rate of vendor. This is repossession rate of vendor. That vendor says that I will reduce this much amount of asset every year till you make the default. Meaning in this question, the default is made in the third year. So the vendor says that I will reduce 30% value each and every year, and the remaining amount, I will take over the asset. So that is repossession value. So in this question, repossession rate is available. When the repossession rate is not given in the question, the closing balance of vendor account will be considered as a repossession value. Again repeating, when repossession, you can refer to question number 14 of classwork. When repossession value is not given, the closing balance of vendor account is considered as a repossession value, and that is transferred to asset account, and asset account will show your profit loss. So this is your question calculation. I'm starting with the calculation part. The first one, these are the installment. Down payment is given. Down payment first, second, and third. Okay. So these are the informations given. So this is your table in which installment values are given. Whenever cash price is not given, understand very well. Whenever cash price is not given, installments will be including interest. Installments will be including interest, and those installments will write down in installment column. First, this information is already provided to you. Okay. Now check what is rate of interest. The rate of interest is given 10%, and installments are annually. So we'll start calculation from reverse. Last third installment, we'll start with calculation part. Now in the last calculation part, in the last installment, the formula will be like 10% is the rate of interest which is included in the installment value. So our calculation will be on 110, 10 rupees interest, what on 2,75,000. Our calculation will be 110, 10 rupees interest, what on 2,75,000. So your calculation will be 25,000. Interest will be 25,000. 275 minus 25 will be closing, will be 250. Closing will be 0 because it's a last installment. 250 cash price will be opening balance. 250, which is your cash price, will be opening balance, and 250 will be closing of second installment. Now we have a second installment amount, that is 2,45,000, and closing we have 2,50,000. If we make the total 245 plus 250, we need to add, every time we need to add the closing balance to calculate the interest portion. So in 2,45,000 installment, we need to add closing of 250. Then total will be 495. Again apply formula on 110, 10 rupees interest, what on 495. So interest amount is 45,000. 245 minus 45 will be 2 lakh rupees cash price. Then 250 plus 2 lakh will be 450. 250 plus 2 lakh will be 450. 450 will be closing balance. 450 will be closing balance. Then 265. In the 265, closing 450 is to be added. 265 plus 450, whatever will be the total. Again apply formula on 110, 10 rupees interest, what on the total installment plus closing. So interest amount will come to 65,000. 265 minus 65 will be 2 lakh rupees cash price, and 450 plus 2 lakh will be 6 lakh 650. Then 6 lakh 50,000 closing in the down payment. Down payment interest will be 0. Cash price will be again 5 lakhs, and 650 plus 5 lakh will be 1150. So this is your balancing figure 1150. Reverse calculation we have done. Now very important thing, 11,50,000 is the value of 2 tractors. If you remember, in the question it was given we have purchased 2 tractors. So 11,50,000 is the value of 2 tractors, and 11,50,000 divided by 2. If you calculate, your answer will be 5,75,000. Value of 1 tractor. Value of 1 tractor will be 5,75,000. Okay. Now calculation further. Now before moving forward to the accounts, we need to prepare a small working note, very important working note, and this working note will give you the answer. This working note will give you the answer. So it's very important working note. In a small working note, we need to calculate value as per purchaser, book value of purchaser, repossession value of vendor, and difference of that is called as a profit or loss. So first I am calculating value as per purchaser. Value as per purchaser, how to calculate, understand. So in this question it is given that the default was made in the third installment, meaning first and second installment is already paid. Third installment ended. At the end of third year the default was made, and depreciation rate of purchaser was given 20%. You can see 20% is the rate of depreciation given. So calculation will be like this: 5,75,000. Out of 2 tractors, only 1 tractor was repossessed. If you remember the question, the 1 tractor was repossessed by the vendor. So 11,50,000 is total cash price of 2 tractors, out of which 1 tractor is repossessed. So 11,50,000 divided by 2, answer is 5,75,000. So this working note will be for 1 tractor only, that is for 5,75,000 only. That is very important. So now calculation is like this: value as per purchaser 5,75,000 minus 20% is the rate of depreciation, and the WD method is followed by the purchaser. So 20% will be deducted for 3 times, as the repossession was done at the end of third year. So 3 years depreciation will be provided, even though the third installment was not provided or third installment was not paid. depreciation will be provided for 3 years, as the repossession must have been done at the end of the 3rd year. So 5,75,000 minus 20%, that will be for 3 times, and the balance amount is 294,400. That is the book value of purchaser. Now next one, value as per the vendor. Value as per vendor is nothing but a repossession value. The repossession value calculation is like this: 5,75,000 minus 30% for 3 times. Minus 30% for 3 times. Why 30%? 30% rate, that is repossession rate given for vendor. And the 30% will be deducted for 3 times. Again, why 3 times? Because the repossession was done at the end of the 3rd year. So 3 years repossession, 3rd year and repossession, that's why 30% again will be deducted for 3 years. 30% is a repossession rate of vendor, and difference closing is 197. The balancing answer is 197,225. Now understand or think from the viewpoint of purchaser that, see, purchaser has a book value of 294,400, and that is taken over by the vendor at 197,225. 294,400 is the book value, which is taken over at 197,225. So the difference amount 97,175, that is the loss to purchaser. This profit loss is always to be understood or to be calculated from the viewpoint of purchaser only, not from the viewpoint of vendor. Remember very well. So difference 294,400 minus 197,225, difference is 97,175, that is loss to purchaser. So this is very important small working note which will very much help you to calculate the answer. Now from this table and this working note, we need to prepare the accounts. First, always will prepare vendor account, and then after always asset account, because whenever the repossession value is not given in question, the closing balance of vendor account will be a repossession value. So always prepare vendor account first. So in the vendor account, the first entry will be for asset purchase. Just to remove this, sorry. Now, understand the entry. The first one, 11,50,000 is the total purchase price. The first entry will be asset to vendor. We are passing in the entries, passing entries in the books of purchaser. So first entry, asset to vendor, that is 11,50,000. Then after the down payment entry, down payment amount is what? Rupees 5 lakh. So 5 lakh rupees down payment entry, vendor to cash or bank. Then after, interest will become due. So interest amount is 65,000. The first interest 65,000. So interest entry is interest to vendor 65,000, interest to vendor 65,000, and then after, installment payment is 2,65,000. Installment payment is what? 2,65,000. So entry is vendor to cash or bank 265, and closing balance will be 4,50,000. Okay, there is one checkpoint of the answer, that closing balance of this table will also be the same closing balance of your account. So 4,50,000 is the closing of first installment. That 450 is the answer here, closing balance. That is opening of second year. Second year, now down payment will not be there. Directly interest entry is to be passed at 45,000. So entry for interest is interest to vendor 45,000, interest to vendor 45,000, and 2,45,000 installment payment. So entry for installment payment is vendor to cash 245, and closing balance of 2,50,000. Closing balance of 2,50,000 will be opening of third year. So now in the third year, interest amount is 25,000. Interest amount is what's 25,000. So entry is interest to vendor 25,000. So even though in the third year the default was made by the purchaser, still interest entry is to be passed, as default was made in the end of the year. Default will be made at the end of the year. So interest for the full year will be charged, even though it is not paid. Interest will be charged. In the year in which default is made, depreciation and interest of that year is to be charged. So interest entry, interest to vendor, and on the reverse side, on the debit side, entry for vendor to cash will not be there. Instead of that vendor to cash entry, whenever normally the installment is paid, we pass entry that is vendor to cash, vendor to cash. But in this last year, the vendor to cash entry will not be passed. Instead of that, entry will be passed for repossession, that is 197,225. Entry will be vendor to, instead of vendor to cash, it will be vendor to asset. Entry will be what? Vendor to asset, that is for 197,225. That is repossession amount that we calculated in the working note. 197 vendor to asset, and the balancing figure will be balance credit down. In the question, it is given that the balance amount is to be paid after 3 months. So in the next, if you want to continue the account, this balance will be opening balance of 4th year, and on the opening balance calculate interest for 3 months, credit interest for 3 months, and on the debit side make the payment vendor to cash and close the account. Next, asset account. Asset account first entry, asset to vendor. Asset to vendor, two tractors purchase, that is asset to vendor 11,50,000. Then depreciation rate is of purchaser, that depreciation rate was 20% of purchaser. So purchaser provide depreciation 20%. So 1150 into 20%, 230, balance 920, carry down to next year. On 920, 20% will be depreciation 184, On the opening balance, 20% depreciation we need to provide. Balance 736 opening of third year. On opening of third year, 20% depreciation we need to provide. So that 20% depreciation on opening is 4,36,000 into 20%, 147,200. Now debit entry is done. Now after depreciation, two more entries we need to pass at the time of repossession, that is repossession entry and profit loss entry. Repossession entry and profit loss entry. After debit, two more entries we need to pass, repossession entry and profit loss entry. Repossession entry is already ready, 197,225. This 197,225 entry was vendor to asset. Entry was vendor to asset. So on the asset account credit side, we need to pass entry by vendor account, and difference profit loss we need to record. Profit loss entry is what? P&L to asset. Entry for profit loss, it's a loss, so entry will be P&L to asset. Entry is what? P&L to asset. It is 97175 P&L to asset. Loss entry. Repossession we pass two entries, repossession entry and profit loss entry. Profit loss entry is what? P&L to asset, and the balance amount, this is the balance amount of one tractor which will be carried down to next year. So because of very important thing, there are two tractors or two assets and only one asset is repossessed, so there will be a closing balance in asset account as well as vendor account. There will be a closing balance of one tractor. So these are similar type, there are similar type of questions in this chapter. This is one question of repossession. All questions are same, just amount will change. And one question, a second method of repossession is not exactly second method. Another type of question of repossession where repossession rate is not given. So repossession rate, whenever the repossession rate is not given, the closing balance of vendor account of last year will be considered as a repossession value, and this total of the last year will be recorded on the debit side and account will be automatically closed. But in a question where repossession rate is not provided in question, the question will be such a question where there will be only one asset. Say in this question there are two assets, so they will have to give you repossession rate. That question, repossession value not given in the question, that is only possible then when there is only one asset and one asset is repossessed, or all the assets are repossessed, then only repossession rate may not be provided. Otherwise, if there are more than one asset and only portion of the asset is repossessed, then they will provide the repossession rate. So that is simple hire purchase concept, and nothing more in this chapter to understood. Just solve any of the questions of hire purchase, any of the questions from classwork or homework. You can like solve two questions from class of 14-15, and for more practice you can solve any of the questions from homework. So all questions are similar, just amount is changing. And this is accounting in the books of purchases. Similarly, you can solve one more question where accounting in the books of vendor is also covered. Regarding goods repossession account, we need to prepare in the books of vendor, that is sales return account, that is available in homework section. So solve one of the question where in the books of purchaser or vendor both accounting is possible. Similar questions are there in homework. You can solve any of the homework questions to understand the concept. So nothing much and nothing more in the hire purchase concept. Thereafter moving to the next chapter of depreciation. So now depreciation, debenture, redemption of debenture. So debenture redemption, that is the next chapter. And now understand the concepts of debenture redemption. What are the different norms to be followed for redemption of debenture? In redemption of debenture chapter, we need to understand the first most important points, that is the sinking fund concept has been removed by the CA Institute from last attempt. The concept of sinking fund has been removed. So all the questions related to sinking fund are not applicable to you. Even questions of past MTP, RTP and past papers questions from debenture redemption chapter are not applicable to you. So for practice of questions for particular this chapter, only a new ICA module is applicable, or you have to practice only from ICA module and the pamphlet which was provided in the classroom lectures. That is the only applicable questions to you. All past questions which were related to sinking fund concept or something different concepts or different DRR rates are not applicable to you. So do not solve any of the questions from any past papers or MTP, RTP for particular this chapter. Just solve ICA module and the pamphlet which was given in the classroom. Now the different changes or corrections done by Institute for this particular chapter are DRR rate has been revised from 25% to 10%. So the new modules are issued by ICI and the rates has been revised, that is for DRR specifically. The DRR new rate is 10%, which is applicable. So for companies issuing debentures, they are required to maintain 10% DRR on all the debentures, total face value of debenture issued, 10% DRR they are required to maintain. And one more additional point is that on total face value, 15% amount they are required to make an investment, that is called as DRR investment. 10% DRR required, 10% reserve, debenture redemption reserve is required, and 15% amount they need to invest in a form of DRR investment. On DRR is calculated on the total face value, and as well as DRR investment is also calculated on the total face value of debenture issue. Okay, so these provisions are to be followed. Based on these provisions, you are required to prepare accounts for this particular chapter. This chapter is now at present, it's very simple chapter. You cannot ignore this chapter, very simple chapter. Only one or two accounts or 2-3 accounts are just required. Nothing much difficult, very simple questions are there. Let's start with the question. How to prepare accounts, which accounts we need to prepare, we'll understand. So question is, again a model question I'm taking. A company is listed company, issued 1,50,000, 5% debenture on 30th September, on which interest is payable half yearly. Company has issued debentures of 1,50,000, 5% interest, and issued on 30th September. And interest is payable half yearly on 31st March and 30th September. Interest is payable half yearly on 31st March and 30th September. Company has a power to purchase debenture from the open market for cancellations thereof. Company has a power to cancel the debentures. Company has a power to cancel the debentures. The following purchases were made during the year ended 31st December 2012. The following purchases were made during the year ended 31st December, meaning company has purchased the following debentures. Company has a power to cancel the debentures. Now for the year ended 31st December 12, company has purchased and the cancellations were made on the same date. Cancellations were made on the same date, meaning company has purchased the debenture from the market and cancelled on the same day. On 31st December, investments made for the purpose of redemption were 22,500. This is DRR investment. 22,500 is a DRR investment which is already made by the company. This is DRR investment available. So company, say in this chapter, we are a company who has issued a debenture. We have issued a debenture of 1,50,000, 5% is the rate of interest. Interest is payable half yearly on 31st March and 30th September. Company can cancel the debenture from the market. Company has purchased the debenture and cancel on the same day. Company has purchased the debenture from the open market and cancel on the same day. So there may be two types of question. Normally, all questions are similar. That company usually will purchase debenture and will cancel on the same day. Another possibility is that company may purchase debenture and cancel later on after 1 month, 2 months, 6 months at the end of year. So that is also possible. Accounting is possible by two methods. Either you can directly cancel debenture account, or you prepare own debenture account and later on cancel to debenture account. Meaning something like this. For example, this is my debenture account. For example, this is my debenture account and I have issued a debenture of rupees 1 lakh. This is my debenture account and I have issued debentures of rupees 1 lakh. Now I want to cancel 10,000 debenture. So I have two alternatives. Directly I debit this 10,000 debenture which I want to cancel to debenture account, and balance 90,000 I will carry down. Another method is that I prepare another account which is called as own debenture account. I prepare another account which is called as own debenture account. This 10,000 debenture which I want to cancel, I will first debit to 10,000 rupees, 10,000 debenture to own debenture account. Again I will close this own debenture account, and this own debenture account will be closed and transferred to debenture account 10,000. So 10,000 if it's debited to debenture account, balance will be 90,000. So directly if you want to debit to debenture account, balance will be 90,000, or if you want to debit to own debenture account, that own debenture account whenever it is cancelled, it will be debited to debenture account and the balance will be 90,000, same in both the situation. So if, for example, in this question, you are required to prepare own debenture account. So meaning you need to prepare these two accounts, debenture and own debenture. If only debenture account is asked, then you don't require to prepare own debenture account, directly just cancel on the debenture account. That is also possible. So based on the question which is asked to you, based on the accounts which we are required, which are required to be prepared, and in the question you need to understand the question, you need to prepare the accounts as per the requirement of question. In this question, company has purchased 2 times debentures, purchased for 2 times on 1st March and 1st September. First they purchased 25,000 debenture, then 20,000 debenture, and amounts are given X interest, cum interest. and you are required to prepare two accounts, that is debenture account and own debenture account, up to date of cancellation. The first important thing is company is required to prepare, or company is required to create 10% DRR. So if debenture value is 1,50,000, total debenture value is 1,50,000. So 1,50,000 into 10%, 15,000 DRR is required. But if you can see in the question, DRR account is not asked in the question. If DRR account is not asked in the question, that 10% DRR criteria, you are not required to check in the question. If in the question the DRR account is specifically asked, then only you need to check that 10% DRR criteria, otherwise not required. Okay, one more thing, in this question DRR investment balance is given 22,500. DRR investment criteria is what? 15% of the face value. So if you calculate 15% of 1,50,000, it comes to 22,500. That company has maintained the investment amount. But that information is again not important for question, because there is just a data provided to you that company has maintained that DRR investment. Company has maintained DRR investment, that data is provided, but that is not useful for this question, because DRR account is not asked, even DRR investment account is not asked. Only debenture or non-debenture account we need to prepare. So that's it. Now, how to prepare debenture account? Debenture account opening balance is 1,50,000. Okay, and company has purchased 25,000 debenture at 24725 x interest. So if it is x interest, we need to calculate interest. X interest meaning prices not including interest. X interest meaning prices not including interest. If it is cum interest, prices including interest. So if you calculate interest portion, it is purchased on 1st March. Interest is payable half yearly on 31st March and 30th September. If it is 1st March, last interest must have been paid on September. So after that, October, November, December, January, February, 5 months interest will be counted. So 25,000 into what is rate of interest? 5%. 25,000, 5% into 5 by 12. It comes to 521. 521 rupees interest. So 521 rupees interest we have to pay because we have purchased. So 521 will be interest. So 24275 is the cost of investment, or that is cost of purchase. 24725 is cost of purchase, and 521 is the interest that we need to pay. But that 521 interest we are not recording here, or we can record extra additionally if we want. Otherwise, it is not asked in the question. So the first entry, company has in the question, we are required to prepare own debenture account. So we'll not directly see. Debentures are purchased and cancelled on the same day. On 1st March, debentures are purchased and cancelled on the same day. So we can follow either directly debit to debenture account, or debit to own debenture account and close own debenture to debenture account. So in this question, own debenture account is asked. So we first need to pass entry in own debenture account. So the first entry will be in own debenture account. Entry will be own debenture to bank. Entry will be own debenture to bank. You are not required to prepare this face value column. That is not required. You can directly prepare this cost column, meaning only amount column will be a single column. Entry will be own debenture to bank 24725. Even interest, if you don't prepare or don't record, that will do, because interest is not asked in the question. Interest account is not asked in the question. They have prepared, but that is not asked. But if you want to prepare, you can prepare an additional account, that is interest account, debenture interest account. So that you can prepare debenture interest account. Entry will be debenture interest to bank. Entry will be debenture interest to bank, that is 5 months interest, and 24725 is cost. Now in the same day they have cancelled the debenture. So this account will be immediately closed on the same day, 1st March, and 1st March 24725 will be credited in this account, and 24725 will be debited in debenture account. Entry is debenture to own debenture 24725. So this account is closed immediately, 24725. This 24725 own debenture closed and transferred to debenture account. Now debenture account will show profit or loss because we have cancelled 25,000 face value debenture. You have paid 25,000 is your liability. 25,000 debenture is your liability. That 25,000 liability you have paid by 24725, meaning you have paid a less amount to debenture holder. So you have made a profit. So 25,000 minus 24725, difference comes to 275. So 275 is a profit and transfer to P&L account. Or you can say that profit is profit on cancellation. In fact, basically on redemption of debenture, the profit will be of capital nature, should be transferred to CR. But first you can transfer to P&L, then after you can transfer to CR. But normally it's a capital profit, it is transferred to CR. So entry will be debenture to profit on, you just write down, it's a profit on cancellation of debenture. So entry will be debenture to profit on cancellation of debenture. That is 275. 25,000 minus 24725, that is 275. After that, another one more time, company has purchased on 1st September 20,000 face value debenture at 20125, but now this time it is come interest. It is purchased on 1st September. Interest is paid half yearly on 31st March, 30th September. Last interest must have been paid on 31st March. So after that, number of months, if we calculate April, May, June, July and August, 5 months interest will be counted. So 20,000 into 5% into 5 by 12, interest amount comes to 417. Interest will be 417. So entries again, first will debit to own debenture account, entry own debenture to bank, 20,000 face value, that is not required to write down. But the cost of purchases provided in the question is 20125. But 20125 is come interest, so we need to deduct the interest to 20125 minus 417, that was interest we counted, 5 months interest, 19708 cost price. So entry is own debenture to bank 19708, interest if you want to record, entry will be debenture interest to bank, and this account will be immediately closed, that is entry and transfer to debenture account, entry debenture to own debenture 19708. So debenture to own debenture 19708 and 20,000 is face value, 20,000 minus 19708, difference comes to 292. That difference is profit because 20,000 liability you have settled for 19708. So 292 is a profit, that is profit on cancellation, and balance 1,05,000 is a balance carried down debenture account. So that is very simple account, nothing much required. One more question I am taking in which there is a DRR account and many other accounts are there, but question is very simple. Question number 4. The following balances appeared in the books of Paradise Limited unlisted company and other than NBFC. The debenture account balance is 12%, debenture balance is 7,50,000, DRR is 25,000, DRR investment is 112,500, represented by 10% bonds of Government of India. Annual contribution to DRR was made on 31st March every year, year ending on 31st March. Bank balance is given 750. Before receipt of interest meaning for current year interest is not received. For current year interest on investment is not recorded. For current year interest on investments is not recorded before receipt of interest, meaning DRR interest is still not recorded. The investments were realized at par. The sentence says the investments realized at par. Investment realized at par meaning what? Meaning investments are sold out. All the investment, that is they are talking about DRR investment. DRR investments are sold out at par meaning at face value 112,500. And debentures redeemed at a premium of 10%. Debentures redeemed at 10% premium. And you are required to prepare debenture account, DRR investment account, bank account, debenture holder account. All accounts are to be prepared. So, a very simple question, nothing is that. First, again I am repeating the question. Debenture account balance is given 7,50,000. DRR account balance is 25,000. And DRR is 10% required. DRR is 10% required on the face value. 7,50,000 debenture into 10% if you calculate. DRR balance should be 75,000. DRR balance should be 75,000. So balance is only 25,000. So we need to increase DRR by rupees 50,000 because we need DRR of 75,000. So we need to increase 50,000 DRR. DRR investment balance is 112,500. If you calculate 7,50,000 into 15% DRR investment required, so answer is 112,500. So DRR investment 15% is properly maintained. DRR is not maintained, so we need to increase DRR balance. But DRR investment is properly maintained. Bank balance is 7,50,000, but in bank balance interest entry is pending. Interest on investment is not recorded, and investment realized at par, meaning investment sold out, debentures redeemed. Investment sold out and debentures redeemed at 10% premium. And we need to prepare different accounts. First one, debenture account. Let's start with debenture account. Or first draw the accounts and write down the opening balances. First of all, debenture account, DRR investment account, bank account. These accounts I prepared. For example, I will first write down the opening balances. So opening balance of DRR debenture is 750, DRR is 25, investment is 112,500, bank balance is 750. Okay, so and debenture holder there is no balance. Okay, so these are the opening balances which I have tick mark. These are the opening balances. Now first of all, DRR requirement is 10%, which is not maintained. So increase DRR by 50,000 by rupees 50,000. So entry P&L to DRR 50,000, and this balance will be 75,000. DRR is maintained now. Okay. Thereafter, company has sold out the investment at par. So now sell the investments. Investments account is this one. This is investment account. So investment sale entry is bank to investment. no profit, no loss as investment realized at par, bank to investment account close. Then after debenture redeemed at premium, the debenture account close and transfer to debenture holder account, debenture to debenture holder. So debenture account to debenture holder account 7,50,000. So debenture holder account will be credited by 7,50,000, but that was redeemed at premium. So entry will be premium redemption to debenture holder account. So 7,50,000 into 10%, 75,000 premium. So entry debenture to debenture holder 750 and premium to debenture holder 75,000, and that is paid to debenture holder 825. So entry debenture holder to bank 825. In bank account there will be entry on credit side bank, debenture holder to bank, so bank account credit side by debenture holder. So debenture account is closed. DRR account, once all the debentures are redeemed, this DRR account will be closed and transferred to general reserve. Once all the debentures are redeemed, then DRR account will be closed and transferred to GR. So entry is DRR to GR. So DRR account is closed. Investment account we have already closed. Debenture holders already closed because debenture holders have made the payment. And in a bank account, you remember interest was pending. So interest on 112500, 10% is the rate of interest. So on 112500 will receive 10% interest, that is 11,250. So entry, that is bank to investment, bank to interest on investment 11,250, and difference 112500 is the 112500 is sale value of investment. There's a sale value of investment debited to investment account, that is already recorded, and 825 paid to debenture holder in balance 48750 is the bank balance closing. So very simple, only one liner accounts are there, nothing much difficult, nothing much complicated, very simple chapter, redemption of debenture. So just practice for this question, nothing much required for this chapter. One theory question is that in this chapter, to which companies DRR rate, what DRR rate is applicable to which companies, that we have done in classwork. We have written notes for the same in the classwork. Just go through that theory, for which companies what DRR rate is applicable. Even in new modules, the rates of 10% of DRR to which companies applicable, that is given to you. And that's it, nothing much required for this chapter. So that's it here for this redemption of debenture. Thank you very much. Hello friends, today we are going to start with a quick revision of chapter investment, second thereafter debenture, and next chapter thereafter hire purchase. These three chapters I'm going to deal with in a quick revision lectures. Now starting with the first chapter, that is investment accounts. See, investment, first of all, understand the definition of investment. The definition of investment says that investments are the assets held by enterprise for earning income in the nature of interest, dividend or rent for capital appreciation. And this investment chapter is covered by AS 13. This AS 13 is dealing with the investment accounts. AS 13 is not applicable to following 3-4 things. AS 13 is not applicable to stock in trade, lease assets, investments in the investments of insurance banking companies, and income in the nature of interest, dividend or rent. Okay, so definition first you have to understand, then after exceptions of AS 13 that you have to understand, then after investments can be divided in two categories, that is long-term investments and short-term investments. Short-term investments are also called current investments, long-term investments are called non-current investments. Valuation of short-term investments are done at cost or NRV or market value, whichever is lower, and long-term investments are always valued at cost price only. Short-term investments valued at cost or market value or NRV, whichever is lower, and long-term investments are valued at cost price only. Cost price meaning what? Cost price meaning purchase price plus all purchase expenses incurred for purchase of this investment. Any expenditure incurred on purchase of investment, that will be part of cost price, and that will be debited to your balance sheet only. Next thing, further investments can be divided in two categories. Investments are two types, short-term and long-term. In this chapter, we are mostly going to cover the short-term investments, because long-term investments are valued at cost price only. So mostly the questions are related to short-term investments, because in long-term investments the valuation is directly at cost price. So mostly questions cannot be created on long-term investments. So all the questions which are in module and are Navkar spiral, all questions are of short-term investments only. Short-term and long-term, two types of investments are that. Okay, valuation that you understood, short-term investments cost or NRV, whichever is lower, long-term investments are valued at cost price only. Thereafter, investments can be further divided into two categories, that is variable income securities and fixed income securities, or you can say first fixed income securities and second thereafter variable income securities. Investments can be of two types, short-term, long-term. Further, it can be divided in fixed income security or variable income security. What is meaning of fixed income security? Fixed income security meaning by those investments on which you get a regular or income on a fixed interval of fixed time period. That is called fixed income investment. Example, debenture bonds are the fixed income securities on which you get the interest or income on a regular interval or a fixed time period. That is called fixed income security. And variable income security, example, equity shares on which dividend rate is not fixed, time is not fixed, and when it is going to receive, that date is also not fixed. So time period and the rate of interest and the occurrence of the income is not fixed. That is called variable income security. And on fixed income security, everything is fixed. The rate of interest is fixed, time period is fixed, and when it is going to be received, that time period is also fixed. That is called fixed income security. And on variable income security, it is not fixed. Now, I'm starting first with the fixed income security. Mostly, this chapter covers short-term investments. In short-term investments, we are going to discuss about the variable income securities and fixed income security. First, I will discuss about fixed income security questions, and then after variable income security. In fixed income security, the questions are basically regarding or covering the concept of or the securities like debentures and bond. So if you see a question and you find that there are debentures or bonds in the question, meaning thereby the question is regarding fixed income security. And if the question is regarding equity share, then it's question of variable income security. So it's very important to identify, first of all, that question is of fixed income or variable income. That identification is very important. If you understand that it's a fixed income security, then which type of question or which concepts to be applied, that you need to understand. If it is a question of variable income security, which concepts to apply, that you need to understand. First of all, fixed income security, I will start with. In fixed income security, you need to understand certain basic things. For example, we are covering fixed income security. In fixed income security, the first point you need to learn or you need to remember, that is, in fixed income securities, investments can be cum interest, investments can be cum interest or ex interest. Investments can be cum interest or ex interest. What is meaning of cum interest and ex interest? Cum interest meaning the security is including interest. The price of security is including interest. That is called cum interest transaction or cum interest security. And if the transaction value is not including interest, interest is to be calculated additionally, that is not included in the price, then that price is called ex interest price. So two types of prices are possible, that is cum interest and ex interest. Cum interest meaning prices including interest, and ex interest meaning prices not including interest, that is cum interest, ex interest. If the transaction is cum interest, then interest we calculate, in both the situation we calculate interest, whether it's cum interest or ex interest, we'll calculate interest separately. In cum interest transaction, we need to deduct the interest portion from the transaction value. In ex interest, we calculate the interest, but we do not deduct or add the interest portion. We record that interest separately. In both the transactions, cum interest, ex interest, we need to calculate interest, but in cum interest transaction, this interest portion will be deducted from the value. In ex interest, it will not be deducted. Okay. Next thing, interest is always calculated. Interest is always calculated on the face value. Interest is always calculated on the face value. Okay. There is one more point to be understood, that is regarding brokerage. Brokerage is calculated on purchase as well as sale transactions. Brokerage is calculated on purchase as well as sale transactions. At the time of purchase, the brokerage we need to pay. At the sale transaction, the brokerage amount will be deducted by the broker. Meaning thereby, if you purchase or if you sell, in both the transaction, brokerage will be calculated. Brokerage is always an expenditure for the investor. For the investor, brokerage is always an expenditure. But at the time of purchase, you need to pay additional brokerage, and at the time of sale, the brokerage is deducted itself by the broker. So at the time of purchase, the brokerage will be added to the cost, and at the time of sale, the brokerage amount will be deducted from the sale value. In the time of purchase, the brokerage amount is to be added to the cost, and at the time of sale, the amount is to be deducted from the sale value. That is concept of brokerage. One more thing, this brokerage is not calculated on the face value. Brokerage is always calculated on the transaction value. Brokerage is always calculated on what? It is always calculated on the transaction value. Again, repeating this 3-4 points. First one, that is cum interest, ex interest. What is meaning of cum interest? Cum interest meaning if price is including interest, that is called cum interest. Ex interest meaning price is not including interest, that is ex interest. Okay, cum interest, ex interest. Interest is always including. Interest is always calculated on the face value. Brokerage. Brokerage is always calculated on purchase and sell both the transaction. Brokerage is calculated on purchase and sell both the transaction. In purchase, the brokerage is to be added, and the sale transaction it is to be deducted. Brokerage is calculated on the transaction value, and interest is calculated on the face value. One more thing, interest is also interest that you calculated by way of cum interest, ex interest. That interest will also be at the time of purchase as well as sale. Interest will also be there at the time of purchase, as well as sale. Meaning, in purchase and sale, both the transaction interest is to be calculated. At the time of purchase or sale, interest is to be calculated. If it is purchase transaction, then interest is your expense. Interest will be an expense. At the time of purchase, interest will be an expense. So it is debited to investment account. And if it is sale, then interest is your income, and that is credited to investment account. So these important things you need to remember for calculation purpose. For solving fixed income security question, you need to understand, or you need to remember this type of concepts. Again repeating, cum interest, ex interest. Cum interest meaning prices including interest, that is cum interest. If price is not including, that is ex interest price. Interest is always calculated on the face value. Interest, again these points are regarding interest, so I am considering or taking this point number 5 together. Interest is calculated on purchase and sale, both the transactions. At the time of purchase, interest will be an expense. At the time of sale, interest will be an income. If you are purchasing, you need to pay interest, so it's your expense. You are selling your investment, that is your income. Brokerage is always calculated on the transaction value. Brokerage is always calculated on the transaction value. At the time of purchase, brokerage will be your expense. At the time of sale, brokerage will be your expense again. Meaning, at the time of purchase or sale, brokerage will be your expense. Meaning, for investor, brokerage is going to be an expense. So, in purchase, the brokerage will be added to the cost. In the sale, the brokerage will be deducted from the sale value. In the cum interest transaction, interest amount is to be deducted. In the ex interest transaction, interest amount is not to be deducted, but it is to be calculated. It is not to be deducted. So, these are the important points you need to remember for calculation purpose. Let's take one example regarding fixed income security. So, I've taken an example, and I'm ready with the answer also. So, just I need to show you the calculation, how to do the calculation of. I will take one example of fixed income security and one example of variable income security. Let's start with question this. Mr. Purohit furnished you with the following details relating to holding of 8% debenture. So if you see, the question is of debenture, meaning thereby it's a question of fixed income security. If the question is talking about debenture bond something, then it's a question of fixed income security. And if it is equity share, the question is of variable income security. This question is of fixed income security. Mr. Purohit furnished you the following details regarding the holding of 8% debenture of 100 rupees each and held as current asset. On 1/4, there is opening balance of 1,20,000, cost price 1,18,000. 120 is face value, 1,18,000 is cost price. On 1st July, 100 debenture purchase, ex interest 98 rupees. On 1st October, 200 debentures sold, 100 rupees ex interest. On 1st January, purchase 50 debenture, 98 rupees cum interest. On 1st February, sold 200 debenture, 99 ex interest. The due dates of interest are 30th September and 31st March. Interest is paid half yearly on 30th September and 31st March. Mr. Purohit closed books of accounts on 31st March, and brokerage is 1% to be paid for each transaction. For each transaction, meaning for purchase and sale, both the transaction brokerage will be 1%. You are required to show the investment account as it would appear in the books of accounts as per FIFO method. Okay, in this question it is specified that you need to apply FIFO method. If it is not specified, you can apply FIFO method or average cost. LIFO cannot be applied. You can apply either FIFO or average cost. If nothing is specified, you apply FIFO. That will be better for you. Average cost method is also simple. In equity share questions, remember very well. In equity shares questions, generally we need to apply average cost method because of like bonus concept or right shares calculation. So over there, in equity share questions, we need to apply normally average cost method. But in fixed income security question, you can apply any of the method. If it is specified, you have to apply that method. In this question, it is specified that it's a FIFO method, so we'll apply FIFO method only. And you need to prepare investment account, that is 8% debenture account. And on 31st March, the market value is 99 rupees. That is for closing valuation. So that 99 rupees is given for closing valuation. So that is your question. First of all, you need to calculate. You need to It's a question of fixed income that you understood. Now, if it is a question of fixed income, then you need to arrange the question date wise. The first and foremost thing that you need to do before starting with the question, the first thing you need to do, that is you need to arrange the question in a date wise sequence. In the date wise sequence, meaning thereby there will be interest transactions during the year. There will be interest transaction during the year. In this question, it is given that interest is payable half yearly. interest is payable half yearly on 30th September and 31st March. This transaction date is given 30th September and 31st March, and accounting year is ending on 31st March. Accounting year is ending on 31st March. So your accounting year is starting from 1st April and it is ending on 31st March. Now you need to first of all check whether the outstanding interest concept is included in this question or not. So your accounting year is starting from 1st April and your accounting year is ending on 31st March. Your accounting year is starting from 1/4 and ending on 31st March. Interest dates are 30th September. The first interest date is 30th September and second interest date is 31st March. So year end is 31st March, interest date is 31st March. So in this question there will not be any outstanding interest concept. But if the date of interest is instead of this September and March, your date of interest is, for example, just giving you example, your interest dates are, for example, June and December. The first interest you are getting on 30th June, and second interest you are getting on 31st December instead of March. Just understand, it is 31st December. If it is 31st December and your year is ending on 31st March, so in this situation, if your last interest is all received on 31st December, then you need to calculate outstanding interest for 3 months, that is January, February, March. You need to calculate outstanding interest. If it is outstanding interest at the end of the year, it is possible that the outstanding interest may be there at the beginning of the question, because on 1/4, if you have a balance of investment on 1/4, if there is an outstanding interest of 3 months at the end of year, then you need to check whether there is outstanding interest at the opening balance also, whether it is there in opening also. So if there is opening balance available in the question on 1/4, if there is opening balance available in the question on 1/4, then there will be a outstanding interest on 1/4 also. Outstanding interest you need to reverse for 3 months in the beginning also. In the closing 3 months interest will be your record. That will be a recording of interest. In the beginning of the accounting year, that 3 months interest will be a reverse of the interest that you recorded in the last year. So that is possible. So remember, first that you need to arrange the question in a date-wise format. In a date-wise sequence you need to arrange. Second, you need to check whether there is any outstanding interest or not. How will you come to know that outstanding interest is there or not in the question? Very simple. Just take the date of accounting year. Your accounting year is from April to March, and your year end is on 31st March, and interest rate is also on 31st March. Then in that situation there will not be any interest outstanding. But if the date of interest is other than 31st March, for example, it is 31st December, then you need to calculate 3 months outstanding interest. If there is outstanding interest at the end of the year, it is possible that there may be outstanding interest at the beginning of the year that you need to reverse. Okay, that is possible. Opening outstanding interest is possible only when there is opening balance available in the question. If there is no opening balance of investment at the beginning, then there will not be any outstanding interest at the beginning of the year. At the end of year that is possible, but at the beginning of year, if there is no opening balance of investment, then there will not be any outstanding interest. So that you need to check. In this question there is no outstanding interest, as the accounting year is ending on 31st March and your interest rate is also 31st March, so there is no outstanding interest. But these are the transactions and in which there will be 2 dates of interest. Interest dates are 30th September and 31st March. So can we say that from 1st July and 1st October, between 1st July and 1st October, there will be interest date of 30th September. So I need to add, or I need to consider that interest date before after completion of 1st July transaction and before moving to 1st October transaction, I need to consider the 30th September transaction, which is considering 6 months interest, and then after the next interest will be on 31st March. Next interest will be on 31st March, and that 31st March will be after 1st of February. So after 1st of February, there will be interest on 31st March. So you need to consider, you need to add 2 interests, that is on 30th September, 31st March in this question. Otherwise, the question is given in the date-wise sequence only. If the question is given in a paragraph format, you need to arrange, like this question is already in a date-wise format. I just added 2 interest dates. And if there are outstanding interest, you need to add that outstanding interest. That if you see any of the question of classwork that we did in the classwork, in the lectures, so you will come to know how we arrange the transactions in a date-wise format. And if there is outstanding interest at the beginning, at the end, you need to even add that outstanding interest at the beginning, even at the end. So this is your total calculation, and this is your question starting. Now question is ready to start. Okay. Now we have not completed the question. Now the question is ready to start, and there is opening balance of 1,20,000 face value and 1,18,000 cost price. So your calculation will start like this. So this is your account, 8% debenture account. This is investment account. There will be five columns on the debit side. On the credit side, there will be 5 columns. Date particulars, face value, interest cost. Date particulars, face value, interest cost. Starting with 1st April. On the 1st April, there is opening balance of 1,20,000 face value. So balance brought down 1,20,000, the face value column, and in the cost column 1,18,000. In the opening, even though there is opening balance in this question, there is no outstanding interest, as the interest date and accounting year date is same. So that in this question there is no outstanding interest at the beginning of the year. If the dates of interest and year end is the date is different, then there will be a outstanding interest in this question. So at present there is no outstanding interest in this question. So on 1/4, face value 1,20,000 and cost price 1,18,000. That is the opening balance. Now the second point was in this question. First point we have covered. Second point comes on 1st July. 1st July, 100 debenture we purchased at 98 rupees. 100 debenture we have purchased at 98 rupees. It's a purchase on 1st of July, 100 debenture 98 rupees. So 100 into 98 and transaction is X interest, meaning thereby interest is not included in the price. So 100 debenture 98 rupees. So calculation will be like this. On 1st July, the transaction calculation will be like on 1st July. Entry will be investment to bank. So in the particulars to bank, 100 debenture into 100 rupees face value. 100 into 100, that is 10,000. And 100 into 98, 100 into 98, that will be 9800 plus 1% brokerage. That was written in the last line of the question, that 1% brokerage is included in purchase as well as sale transaction. In purchase, brokerage will be added. In the sale transaction, brokerage will be deducted. So 100 into 98 makes 9800, 9801 plus 1%. That is 9898. And interest is not included, so interest will calculate, but will not deduct from the transaction value. 9898 is the transaction cost price, and interest now will calculate. So purchase date is 1st July. Interest is payable half yearly on 30th September and 31st March. So if it is 1st July, last interest must have been paid on 31st March. Interest dates are September and March. Last interest must have been paid on 31st March. So number of months, if you calculate April, May and June, 3 months interest we need to calculate because it's the 1st July. So July will not be included. So April, May and June, 3 months interest we need to calculate. Rate of interest is given 8%. So 10,000 into 8% into 3 by 12. It comes to 200 rupees interest. So 200 rupees interest we need to debit. So interest will be debited at the time of purchase. Interest will be credited at the time of sale. And 200 is not deducted from 9898 because it's an X interest transaction. If it is cum interest transaction, we need to deduct that 200 from 9898. Okay. So that is purchase transaction. After purchase transaction, what was the next point? Check. The next point is on 1st October. On 1st October, okay, before 1st October, there is interest date is 30th September. So interest we need to calculate on 30th September, and interest will be credited. Interest will be credited to investment account. On 30th September, say on the debit side, what is interest is always calculated on the face value. So on the debit side, if you check the face value is 1,20,000 opening plus 10,000 purchase. Total face value is what? 1,30,000. So 1,30,000 into 1,30,000 into 8% and half yearly, that is 6 by 12. Interest comes to 5,200. So interest will be credited on the investment account. Interest bank to investment. So that is transaction for investment. Interest calculation thereafter. Interest calculation, 200 debentures sold X interest at 100 rupees. On 1st October, sale transaction. Sale transaction will be credited to investment account. So by bank, 200 into 100, 20,000 rupees face value. And that was sold at rupees what? Investment sold at 100 rupees only. So 200 into 100 will be 20,000 and 1% brokerage in purchase and sale both the transaction. In the sale transaction, the brokerage will be deducted. So 200 debenture into 100 rupees sale value. So that will be 20,000. 20,000 minus 1% brokerage. 20,000 minus 1%, that is 19800. So that 19800 is a sale value. And it is 1st October and interest rate is September and March. See, last interest we calculated on 30th September and this transaction is on 1st October, very next day of the interest date. So in this transaction on 1st October, interest will not be calculated. Whether it's a cum interest, X interest, whether it's written in the question, interest will not be calculated because last interest we calculated on 30th September. So it's a very next day, so interest will not be calculated. But in sale transaction, we need to calculate the profit or loss. So in this transaction, we need to calculate profit loss, and for profit loss calculation, we need cost price. For cost price calculation, we are applying FIFO method as given in the question. Every time at the time of sale, you need to calculate profit loss. For profit loss, we need to calculate cost price, and for cost price, we need to apply either FIFO method or average cost method. In this question, it is given that we need to apply FIFO method, so we'll apply FIFO method. This 20,000 investment, we must have sold out of this opening balance only, because we have opening balance of 1,20,000 investment and we have sold out 20,000 debenture. So out of this 1,20,000, we must have sold out 20,000. So we have a cost price of 1,20,000, that is 1,18,000. 1,18,000 is the cost price of 1,20,000. So we'll calculate like this: 1,18,000 divided by 1,20,000, cost divided by face value. 1,18,000 divided by 1,20,000 into 20,000, the investment sold out. So cost comes to 19,667. Cost comes to 19,667, and that 19,667 is cost price, and 19,800 is sale value. So 19,667 minus 19,800, difference come to 133. Sale value is higher, cost price is lower, so it's a profit. Profit debited to P&L account, meaning investment account, investment to P&L. That is 1st October, profit entry 133. 19,800 minus 19,667. Thereafter, next transaction after sale, the next transaction comes on 1st January. On 1st January, we purchase 50 debenture, 98 rupees come interest. 50 debenture we purchase, 98 rupees come interest. So on 1st January, the purchase entry, investment to bank, 50 debenture into 100 rupees, 50,000. And we purchase at rupees, what is the purchase price? Just check. 50 into 98 rupees. We purchase at 98 rupees. So 50 into 98 comes to 4900. 4900 plus brokerage. Plus brokerage, if you calculate 1% is brokerage, 4900 plus 1% comes to 4949. But this transaction is come interest, not X interest this time. This transaction is a come interest transaction, it's not X interest. So if it is come interest transaction, we need to deduct the interest portion also. So you remember, whenever you are calculating like this question, I am not calculated, suppose I am not calculated this cost price, I am just calculating, once again I am repeating the entry, that is investment I have purchased, that is 100 debenture I have purchased out of 100 rupees face value. So entry is investment to bank, 50 debenture into 100 rupees, that is 5,000. Now the date of purchase is 1st January, and last interest we must have paid on 30th September. So number of months, if you calculate for interest purpose, if you calculate number of months, last interest was paid on 30th September. So number of months will be October, November, December. January will not be included because it's a 1st January. So 3 months interest we need to calculate. So 5,000 into 8%. The rate of interest is 8%. So 5,000 into 8% into 3 by 12. It comes to 100 rupees interest. So 100 rupees interest I have recorded. That is 100 rupees in interest column. Now the purchase price is what? The purchase price is given 50 into, again repeating, 50 into 98 rupees. 50 into 98, if you calculate 50 into 98, it comes to 4900. 4900 plus 1% if you add interest, brokerage if you add 1%, it comes to 4949. That in 4949, 100 rupees interest is included. So that interest is to be deducted from the value, that 4949 minus 100 rupees, so it will be 4849. 4949 minus 100 rupees interest, because it is come interest, so it will be 4849. Thereafter, the next transaction after purchase, next transaction comes on 1st February, 200 debentures sold, 99 rupees ex interest. So 200 debentures sold on the credit side 1st February, buy bank 200 into 100, 20,000 face value. Calculate interest. If it is 1st October, last interest must have been paid on 30th September. Number of months, calculate October, November, December, January. Okay, February will not be included because it's a 1st February. So it's October, November, December and January. 4 months interest we need to calculate. 20,000 into 8% into 4 by 12. It comes to 533 interest. 4 months interest comes to 533. It's X interest. So from sale value, just brokerage will be deducted, but interest will not be deducted. What is the sale value? Just check. 99 rupees is sale value. So 200 into 99, just calculate 200 into 99. It comes to 19,800 minus 1% brokerage. In sale, brokerage will be deducted. So minus 1% comes to 19,602. And if it is sale transaction, we need to calculate profit loss again. So profit loss, if you want to calculate, again, this 20,000 we have sold out. But you need to check from which investment, from which purchase we have sold out this 20,000. Because for sale or for calculation of profit loss, we need to calculate cost price also. For profit loss calculation, we need cost price. So we are checking what is cost price. So I'm applying FIFO method, first in, first out. Say in the opening, I had 1,20,000 investment. Out of 1,20,000, I have just sold 20,000. So that is 1 lakh balance. That is opening balance of investment of 1 lakh face value. So can I say that this 20,000 is also sold from opening balance only? This 20,000 is also sold from the opening balance only. So again, I will calculate this. I will consider this 1,18,000 cost price for calculation purpose. So my calculation will be 1,18,000 divided by 1,20,000. This cost divided by this face value. 1,18,000 divided by 1,20,000. Cost divided by face value into 20,000. The investment face value which I have sold into 20,000. The face value of the investment which I have sold. Cost price again comes to 19,667. 19,667, because the same cost price will be there because of 20,000 again I am selling. So 19,667 is the cost price and 19,602 is sale value. So difference 19,602 minus 19,667, 4 rupees or 65 rupees is a loss, and loss among entry is P&L to investment. It's a loss. Sale value is lower and cost is higher. So sale value is lower, so it's a loss, and loss entry is P&L to investments. On the credit side, the 65 rupees will be recorded P&L to investment. So for sale, every time you need to calculate profit loss. And the last point, in 1st February we have done. After 1st February, there is interest date of 31st March. So one more interest calculation is just pending. 31st March, interest calculation will be by bank. And now check what are the investments pending with you. What are the remaining investments with you? So in opening, there is 1,20,000 face value. Again, we purchased 10,000. Again, we purchased 5,000. So opening 120 plus 10, 130 plus 5 purchase 135. Out of 135, we have sold out. Out of this 1,35,000, we have sold out 40,000 investment. So remaining investments are 95,000. On 95,000, 8% interest we need to calculate for half year. So it comes to 3800. 9500 into 100 into 8% into 6 by 12. It comes to 3800 interest. So entry is bank to interest. It is not outstanding interest because interest rate accounting year is same. So it's not outstanding interest. That interest is received interest. Interest entry is what? Bank to interest. Thereafter, the last point, closing valuation. So for first closing valuation, just need to close the face value first of all. The face value comes to 95,000 debit minus credit side. Face value comes to 95,000, and for this 95,000 we need to calculate cost or market value, whichever is lower. So for this 95,000 we need to calculate cost or market value, and the lower amount will be recorded over here. Now I am calculating cost price. This 95,000 cost calculation I need to apply FIFO method. Say for FIFO method, first in first out. So 95,000 is a closing balance, but how I got that 95,000? From which purchases 95,000 has arrived? You need to check first thing. So I have sold 2 times, that is 20,000, 20,000 I have sold, that is for 2 times. That 40,000 I have sold from this opening balance only. So from opening balance 40,000 is sold out. So can we say that from opening 80,000 is left? From opening 80,000 is left. This 10,000 is as it is left, and this 5,000 is as it is left out. So from opening it is 80,000 plus 10,000, that is 90,000 plus 5,000, total comes to 95,000. So this 95,000 is a combination of 80,000 plus 10,000 plus 5,000, that you understood as per FIFO method. So from opening I need to calculate what? I need to calculate cost of 80,000. From opening I need to calculate cost of 80,000. From second purchase I will keep the same value cost 9898. That cost I need to keep as same because there is no change in or no sale from this 10,000, and this 4849, that cost will remain same. That 4849 cost will remain same. For this 80,000 I need to calculate cost. So for 80,000 if I calculate cost, 1,18,000 is cost. See, 1,18,000 is total cost divided by total face value 1,20,000. So 1,18,000 divided by 1,20,000 into 80,000, it comes to 78,667. Cost of this 80,000 is face value, and cost of that is 78,667. 78,667, and plus this cost as it is we need to keep. So total of this 3, 1, 2 and 3, 78,667 plus 9898 plus 4849, it comes to 93413. 93413, that is total cost. And market value is given in the question. If you see the last line of the question, the market value says that 99 rupees. So 99 rupees if you calculate, see we have 95,000 closing face value. 95,000 divided by 100 if you make, it will be 950 debenture. It will be 950 debenture. 950 debenture into 99, if you multiply, it comes to 94050. Face value, quantity 950 into market value 99 rupees. If you multiply, answer comes to 94050. That 94050 is market value and 93413 is cost price. Market value and cost price comparison, cost is lower, so in the account we need to record cost price, and whenever you record cost price in the account, automatically your cost column will tally. If you put your market value is lower, if market value is lower, and if you put the market value here, then your cost account will show a difference. Your cost column will show a difference equal to market value and cost price. Difference will be recorded in cost price. So in a simple terms, whenever you record cost as a closing valuation, your cost column should automatically tally. And if there is face value, if you have recorded that face value in the closing valuation, your cost column will show difference, and that difference will be transferred to P&L account. So this is question of fixed income security. And after this, next question I am taking regarding variable income security. In a variable income security, 2-3 important points you need to consider. You need to remember about variable income security. This fixed income security we have done. The second concept of the chapter, that is variable income security, we need to cover. And in variable income security, very important concepts are regarding bonus shares, right shares, and a dividend. These 3 concepts are very important: bonus shares, right shares, and dividend. I'm repeating the concepts first of all. I'm just revising you the concepts, that is for bonus share. How the accounting of bonus shares is to be done. Bonus shares are given free of cost to the shareholders. So there is no accounting entry passed in the books of the investor for bonus shares. Only face value we need to increase. And due to bonus shares, your cost per unit will decrease. Your cost per unit will decrease, and at the time of sale or at the time of cost calculation, we need to apply average cost method every time. Again, I'm repeating. You need to understand concepts of bonus shares, right shares, and dividend. The bonus share concept, first of all, we need to understand, that is, bonus shares are given at free of cost to the shareholders by the company. And whenever a bonus shares are received, we are not required to pass any entry for the bonus shares, as they are free of cost, and no accounting entry is passed for any amount received free of cost. So for bonus shares, whenever bonus shares received, we just need to pass or record transaction or record the face value column only. We are not recording in a cost column. Due to bonus shares, your cost per unit will decrease. Your cost per unit will decrease, and whenever after receiving bonus shares, whenever you calculate cost price for sale calculation, for the time of sale, when you calculate profit loss, you need to calculate cost price, or at the time of closing valuation, we need to calculate cost price. So whenever you calculate cost price later on, after receiving bonus shares, you compulsory need to apply average cost method. You cannot apply thereafter FIFO method. So normally in equity share questions or variable income security questions, we need to apply the average cost method. We cannot apply the FIFO method. Okay. So that bonus share concept we revised. Thereafter, right share. Right shares are given at the lower price than the market value to the shareholders, to the existing shareholders by the company. That is, the existing shareholders get the benefit of a lower share purchase price from the company whenever company is issuing additional shares in the market. Already company has issued certain shares to the shareholders, and company is again issuing a share, similar type of shares in the market. So company is offering the shares first to the existing shareholders at the price which is lower than the market value. Then after, if shareholder wish to purchase, then they can purchase the shares. If the shareholder don't want to purchase, then they can forego their right, and they can even sell their right to outsiders. Meaning existing shareholders have two options or three options in fact. Either existing shareholders, if they are getting the right shares, they can either purchase a full right with the price offered by the company. Second, they cannot, if they do not wish to purchase, they can forego their right, then that right will expire. They can purchase the first option available with the shareholder. They can purchase the full shares with the price decided by the company. Second, if they do not want to purchase, they can forego the right. That right will expire. Third option that is available, that is, they can sell their right shares to the outsider. They can sell their right shares to the outsider, and that outsider will purchase from the company. And for selling the right share to the outsider, they will get certain commission. And we need to pass commission entry. If we are selling our right to outsider, then we need to pass that commission entry in our books of accounts. And the fourth option that is available, there is normally three options are there, but fourth option is also possible if company allows so. If company allow the shareholder, that shareholder can either purchase certain portion and sell certain portion to outsider. Meaning, for example, I am getting 1000 shares as a right share at some, for example, 15 rupees per share, and I want to purchase only 500 shares, and I can purchase 500 shares and I can sell the remaining shares to outsiders, and for which I will get the commission. That is also option available. So whenever you get a right shares, mainly three or you can say four options available. First, either you purchase all the shares which is offered by company as a shareholder, that is in a form of right shares. Either you do not purchase any shares, the right will expire. Third option, either you sell whole of the right shares to the outsider and get the commission from the outsider. And the fourth option, that partially you purchase and partially you sell the right to outsider. That is option available regarding right shares. Thereafter, the next point, that is there is variable income security. First we discuss about bonus shares, second we discuss about right shares, and then after the third point, the important point is that is regarding dividend. Dividend can be of two types. Dividend can be a final dividend or an interim dividend. Dividend can be of two types. It can be a final dividend, it can be a interim dividend. Final dividend can be of revenue nature as well as capital nature. Final dividend can be of revenue nature as well as capital nature. Interim dividend will be always of revenue nature. Interim dividend will always of revenue nature. Final dividend can be of revenue as well as capital nature. Interim dividend will always be of revenue nature only. Now, how will you come to know about dividend is a final dividend or interim dividend? If it is interim dividend, it will be specifically given in the question that it's interim dividend. The words will be written that company has declared interim dividend at this percentage. And one more important thing, in calculation of dividend, whether it's interim or final, in calculation of dividend, we are not required to apply months. It will be for 12 months always. Whether it's received on any of the dates, it is received on October or September or any of the dates, a dividend is received. Dividend will be calculated for all 12 months. You are not supposed to calculate number of months for calculation of dividend. Dividend can be a final or interim. If it is interim dividend, it will be specifically mentioned in the question that it's an interim dividend. If it is final dividend, how will you come to know it's a final dividend? See, if company is declaring dividend or paying dividend after their year end, if company is paying dividend after their year end, then dividend is called as a final dividend, and that final dividend can be of revenue nature as well as capital nature. Okay. How will you come to know whether it's a capital nature dividend or revenue nature dividend? Just take an example and we'll understand the concept regarding dividend. Again, I'm repeating, dividend can be of, I'm writing here again, dividend can be of final dividend, dividend can be of final dividend, or dividend can be interim dividend. Dividend can be a final dividend or a interim dividend. Interim dividend will always be of revenue nature, and it is credited to P&L account. You need to just mention this interim dividend into a which column? Into your dividend column, and it is transferred to P&L account. Final dividend can be of capital nature. Final dividend can be of capital nature or can be of revenue nature. Final dividend can be of capital nature, can be of revenue nature. If it is revenue nature, it is transferred to dividend column and transferred from dividend column to P&L account. If it is revenue nature, transferred to record to dividend column and it is transferred to P&L account. If it is capital nature, then it is to be credited to cost column. Credit to cost column. Credit to cost column. Okay, so credit to cost column, and if it is credited to cost column, meaning thereby you are reducing your cost. If it is capital nature dividend, that will reduce your cost. That will not transfer to P&L account. That will reduce your cost. And how can we reduce our cost? By crediting to cost column, we can reduce our cost. Okay. So now important thing is that how will you come to know whether it's a revenue nature dividend or capital nature dividend? That is more important thing. For example, I am taking one example. For example, my accounting year is starting from 1/4/19 and the year is ending on 31st March 20. My year is starting from 1/4/19 and year is ending on 31st March 20. Understand very well. Now, company has declared and paid dividend of this accounting year. This accounting year is 1920. We can say accounting year is which? 1920 is the accounting year. For this accounting year, company has declared and paid dividend on 1st October 20. Company has declared and paid dividend on 1st October 20 for previous year 1920. So, company has declared and paid dividend after the year end. It's a final dividend. Company has declared and paid dividend after the year end. After 31st March, in 1st October, they have paid the dividend. So, it's a final dividend which is declared and paid after their accounting year. That is final dividend. Now, on 1st October, if I am receiving dividend, that dividend can be of a capital nature, can be of a revenue nature. So, which dividend will be of capital nature, which dividend will be of revenue nature, that we need to understand. Now, understand. If I have purchased shares in the previous year 1920, for example, I have purchased shares on 1st July. On 1st July 19, I have purchased, for example, 1000 shares. I have purchased 1000 shares on 1st July. I have certain 500 shares on opening on 1/4 opening. I had 500 shares. On 1/4/19, I had opening shares of 500. On 1st July, I purchased 1000 shares. Okay, one more example. I purchased shares on after 31st March. For example, on 1st June, I purchased another, for example, 200 shares on 1st of June after 31st March. Say 1st July, that is before 31st March. 1st June, that is after 31st March. 1st June 20, that is after 31st March. And on, for example, 1st July, company has issued 100 shares in a form of right or bonus. Company has issued 100 shares on 1st July 20 after 31st March as a right or bonus. Now, in this 4 type of shares, there is one share on 1st April, that is opening. There is one share on 1st July, that is purchased on 1st July 19. On 1st June, I again purchased 200 shares. On 1st June 20, I purchased again 200 shares. On 1st July, company has paid 100 shares in a form of right or bonus. Anything can be a right or can be a bonus. For example, that is received on 1st July. Now, my question is, which dividend will be of revenue nature? Which dividend will be of capital nature? That is very important. Which dividend will be of revenue nature? Which dividend will be of capital nature? And on which shares dividend will not be received? On which shares dividend will not be received? So very important, company is paying dividend for the year 1920. Company is paying dividend for the year 1920. In the year 1920, this bonus and right shares which are newly issued. The 1st July, on 1st July 20, company is giving right shares and bonus shares on 1st July. That is totally new issue which is paid by company, new shares issued by company, that is totally new shares issued, were not existing in the previous year 1920. Company has paid dividend for the year 1920, in which year the right shares and bonus shares were not in existence. So company is not liable to pay dividend on this right and bonus shares, even though the dividend is received on 1st October after 1st July. Even though the dividend is received on 1st October, after 1st July, after receiving in bonus and right shares, you have received a dividend, but still right and bonus shares are not entitled to any dividend, as these shares are not in existence. These shares were not in existence in the previous year 1920, and dividend is of previous year. So on bonus and right shares, dividend is cancelled, no dividend payable. Next point. Whether on 500 shares and 1000 shares dividend will be received? Yes, of course it will be received. And on 500 shares and 1000 shares dividend will be received, and that dividend will be of purely revenue nature and transferred to dividend column, from dividend column transferred to P&L column. See, in the dividend is of previous year 1920. Very simple thing. Dividend is of previous year 1920. This 500 as well as this 1000 shares were in existence, as well as we had those 1500 shares in the previous year itself. The shares were in existence, as well as we were the owners of these shares in the previous year also. We were the owners of these shares in the previous year also. So on this 1500 shares, the dividend received will be of purely revenue nature, and 1500 shares are entitled to dividend, and dividend will be of revenue nature transferred to P&L account. But very important, we have purchased shares on 1st July, 200 shares we have purchased on 1st June, sorry. On 1st June, we have purchased 200 shares, which is after 31st March. After 31st March, we have purchased, on 1st June, we have purchased 200 shares. If we have purchased 200 shares on 1st of June, these shares are entitled to dividend or not? Yes, these shares are entitled to dividend, as these shares are not newly issued shares like right or bonus. These shares are not newly issued shares like right and dividend. These shares were in existence in the previous year. Though we were not holding those shares in the previous year, someone else was holding these shares in the previous year. But these shares which we purchased on 1st June, we have purchased from the market. This is not newly issued by company. On 1st June, we have purchased the shares from market, not from company, and these shares were in existence in the previous year. These shares are entitled to dividend, but these shares were not held by us. These shares were not held by us in the previous year. So dividend will be received. Dividend will be received on 1st June shares. The shares purchased on 1st June are entitled to dividend, but for us, it is not a revenue nature income, because these shares were not existent. These shares were in existence, but were not held by us before 31st March. The shares were not held by us before 31st March. So dividend will be received, but it will be of capital nature, as the shares were not held by us in the previous year for at least 1 day. So this dividend will be of capital nature, and dividend received on these shares will not be credited to dividend column, that will be credited to cost column. And if it is credited to cost column, then that will reduce the cost. So whenever in future you calculate cost price, you need to deduct that cost portion, that you need to deduct that dividend portion for calculation of your cost price. Whenever you calculate the cost for the purpose of sale at the time of sale or closing valuation, you need to deduct that dividend portion from your total cost whenever you calculate the average cost. So that dividend point is very important. So 2-3 points are very important for this calculation purpose, that is bonus shares, right shares, and dividend. Again, repeating very fast. First, bonus shares concept. Bonus shares are received free of cost from the existing shareholders. No counting entries to be passed for bonus shares. Bonus shares, just we need to debit the face value. We need to record in the face value, because face value is not the account in fact. So we can record in face value column, but in cost column we are not recording anything. Due to bonus shares, cost per unit will decrease, and after receiving bonus shares, we have to compulsory apply average cost method. Next one, right shares. Right shares are received by the existing shareholders at the price which is lower than the market value, which is given by company to their existing shareholders. Existing shareholders either purchase the whole right given to them, either they can relinquish their right, or they can forego the right, and the right will expire. No entries need to be passed at the time. Either shareholder can sell their whole of the right which is received from the company to outsider, and can get commission. That commission will be credited normally to P&L account. It will be recorded in normally the commission received from sale of right we are recording in a footnote to the account. After account completion, we just write down income received from sale of right. We just write down in a by way of note to the account. In the last line of the account, we just write down as a note that the income received from sale of right is received this much and will be credited to P&L account. Just we need to give a note for the same, that commission. And thereafter, the fourth option available to the existing shareholder, that if the right shares are issued, a shareholder can either purchase certain portion and partially they can purchase the share and partially they can sell the shares. And if they have purchased certain portion, purchase entry will be passed. If they have sold out the right, then income received, commission received will be recorded as a note to that account, investment account. That investment, that right sale income will be credited to P&L account. This we need to show by way of note to investment account. Okay, so that was the right share calculation. Dividend can be of two types: final dividend, interim dividend. Interim dividend will be always of revenue nature. Final dividend can be of capital plus revenue nature. Capital column, capital nature dividend will be credited to cost column, and that will reduce your cost. Revenue nature dividend will be credited to dividend column and transferred to P&L account. So these are the concepts of revenue nature questions, or you can say variable income security questions. And there is one more method, that is mixed method of fixed and variable. So in fact, that is not a new method. Maybe a question may be given to you, that is combined question of fixed and variable. So in those questions, if it is a combined question of fixed and variable, what you need to do, you need to just bifurcate the transactions of fixed and variable. Just bifurcate and calculate the question as if there are two questions, one question of fixed income and one question of variable income. Just calculate like that only, as if there are two different questions are given to you. And that's it. The different concept we have, almost all concept we have discussed. One small point is pending, and that was in this last RTP that I need to discuss. So just need to discuss one small point of RTP. Now we are discussing that point. So in right shares calculation, there is a small concept regarding right shares calculation. Income from sale of right can be normally we consider that income from sale of right as a revenue nature income. And that revenue nature income, we just write down the answer as a note to your account. Below your account, we just write down the answer that income from sale of right is this much, and that is credited to P&L account. So if no information or no additional information is specified, we consider the income from sale of right as a P&L income or revenue nature income and transfer to P&L account. But there is one situation where right sale income can be of a capital nature, where again I am repeating, there is one situation where right sale income can be of capital nature income, and this is one of the situation given in the RTP in the last November 20 RTP. There is one situation given. Till now they are not asked any type of question regarding this concept. This concept is there in accounting standard number 13. This concept is there in AS 13, but there is no question in ICA module. Even they are not asked in any past exams this type of questions. So this is for the first time. There is this type of concept which is in RTP. Very simple concept, but this concept is for the first time in the RTP. So we need to discuss and we need to understand the concept. The first time I'm explaining you the concept. What is the concept? The concept is regarding say income from sale of right. The concept is regarding what? Income from sale of right. If the provisions which I'm going to discuss, if such provisions are not there, if the concept is not there in your question, then income from sale of right you need to consider as a revenue nature income, and you need to just give your answer below your account that income from sale of right is revenue nature income and will be credited to P&L account. That will be your answer as usual that you are doing. That will be your answer. If the provisions which I am going to discuss are not there in the question, your answer will remain same as you are doing. No change in your answer. But there is one provision regarding income from sale of right. Income from sale of right. That income from sale of right normally will be considered as a revenue nature income. But there is one situation where income from sale of right can be considered as a capital nature income, and as dividend is recorded in cost column, whenever dividend is of capital nature, whenever the dividend is of capital nature, we record in the cost column, and at the time of calculation of cost, we reduce that cost amount, that dividend amount from the total cost. Similarly, income from sale of right normally will be of revenue nature, but there is one situation where dividend from sale of right can be considered as a capital nature income, and that will reduce your cost. What is the situation? The situation is very simple. AS 13 says that two things. The first thing, that whenever you purchase equity shares on come right basis, whenever you purchase equity shares, the first provision, whenever you purchase equity shares on come right basis, the shares must be a come right share. Come right share meaning the right shares, the shares that you purchase are with right. That is come right shares. The shares must be come right shares. The shares are attached, the right has been attached to the shares purchased. So the information will be provided in the question that the shares you have purchased are come right, not come dividend or come interest. It is come right. The shares must have been purchased come right, and after becoming X right, after say once the rights are issued, the shares become X right. So after becoming X right, the price of the shares reduce below your cost price. the price of the shares reduced below your cost price. Again repeating, the first provision says that the shares must have been purchased. What I'm talking about income from sale of right. Income from sale of right. Income from sale of right is normally considered as normally income from sale of right is considered as a revenue nature income. But there is one situation where income from sale of right can be considered as capital nature income, and that situation is like this. 2 points you need to remember. The first one, the original shares must have been purchased on come right basis. The original shares must have been purchased on come right basis. And second, after becoming X right, the price of the shares fall below original cost. After becoming X right, the shares of the price fall below original cost, and due to that you have to incur a loss. In that situation, income from sale of right till your loss amount will be of capital nature, and over and above the loss amount will be of revenue nature. Okay, I understood. You will not understand the provision. Just see the question. You will understand the calculation what I am talking about. The question given in this RTP is like this. You just see the calculation. You will understand what I am talking about. I will just correlate those provisions in this question also. See, the question is like this. Mr. X acquired 200 shares on come right basis. The words given here, Mr. X acquired the shares on come right basis. The shares are acquired on come right basis at rupees 60,000. What is 60,000? 60,000 is your cost. How many shares you purchase? 200 shares you purchase. At what price? 60,000. 60,000 is come right or X right? Come right purchase. Okay. He subsequently received an offer of right to acquire fresh shares in the company in the proportion of 1:1. So you have received a right shares, you have received a right option, that is 1:1. On 200 shares, you can purchase another 200 shares at 105 from company. Company has offered you 200 shares to purchase at 105 rupees. It does not subscribe, but sell the right at rupees 15,000. So we have not purchased the right, we have sold out the total right. We have sold the total right at what price? 15,000. So what is that 15,000? 15,000 is your commission income that you have received. Okay, originally we purchased the shares at what price? 60,000. Original shares we purchased at rupees 60,000, and from income that we receive from sale of right is what? 15,000 is income from sale of right. Normally that income from sale of right we are transferring to P&L account. We are recording as a note to your investment account that this 15,000 is of revenue nature and will be credited to P&L account. But in this question there is somewhat change. What is changed is the last line. The last line says the market value of the shares after the becoming X right, the price has gone to rupees 15,000. Now understand, your original purchase price was 60,000. After becoming X right, the shares price has gone below. The shares price has fallen to rupees 50,000. So can we say that we have incurred a loss of rupees 10,000 originally because we purchased for rupees 60,000? Now the price of the shares has down to rupees 50,000. So what is your loss amount? 10,000 is your loss, you can say, not actual loss, but because the market value has fallen down, in future you will incur a loss of rupees 10,000 whenever you are going to sell. You are going to incur a loss of rupees 10,000. But against that, you have received income of rupees 15,000 from sale of right. So what you need to consider, we have received income of rupees 15,000 from sale of right. Out of this, my 10,000 loss I need to first of all write off. And out of this 15,000 income that is from sale of right, 10,000 will be considered as capital nature, as I have incurred a loss of rupees 10,000. The 10,000 will be considered as of revenue nature, that is capital nature, and the remaining 5,000 that will be considered as a revenue nature. 10,000 of capital nature and 5,000 of revenue nature. 10,000 will reduce my cost because I have incurred a loss of rupees 10,000 due to that right. I have incurred a loss of 10,000. So 10,000 will be adjusted against the cost and 5,000 will be credited to P&L account. So that is the provision. Now again repeating the provision, now you will better understand the concept. The provision says the first concept, the original shares must have been purchased on come right basis. If your question is not specifying that, the shares are purchased on come right, the come right word is not given in the question, that this concept is not applicable for you. When the come right word is not there in the question, then this concept is not applicable to you. So there must be the original shares you must have purchased on come right basis. And the second point, after becoming X right, the second concept, after becoming X right, the shares have become X right, and after becoming X right, the price of the shares has fallen below its cost price. After becoming X right, the price of the share fall below its original cost price. the original cost price of 50,000, 60,000, and after becoming X, right, the price fall to rupees 50,000. So there is a loss of 10,000. So till the amount of loss you need to adjust from your income from sale of right. You receive income from sale of right as 15,000. You need to first adjust that loss, and then that to adjust that loss, that 10,000 will be considered as capital nature, and that remaining 5,000 out of this 15,000 will be considered as revenue nature income, will be credited to income column, or that 5,000 you can record below that account. That 5,000 income will be credited to P&L account as usual that you are doing. So your answer will be like this. If you prepare account, your answer will be like this. 10,000 you need to show on the credit side of cost column. Credit side of cost column 10,000, and 5,000 income. Just you need to show by way of note to investment account that 5,000 is revenue assured income will be credited to investment account. So this is important new concept which is there in the last RTP. So that was a new concept that we have discussed, and that's it. Everything is same. Just you need to for practice just solve two questions, one from fixed income, one from variable income. Either I can say like from classwork questions you solve first second question, or first second question from classwork, and from classwork again question number 5. There's 3-4 questions, 2-3 questions in fact enough for this chapter. Question 1, 2 and question number 5 from classwork. That is, I think, enough for revision of this chapter. If you have done the whole chapter, if you have solved all the questions once, then for revision just need to solve these 3 questions only, and this new concept which is applicable in this or which was there in the RTP. It was applicable, but that was not in the module. So latest they have added, so we have discussed. So here we are completing this concept or revision of the chapter investment account. Next chapter, after this we are starting with the hire purchase.
Hello dear students, myself CA NIKUNJ AMLANI, faculty at Navkar Institute. Today I am just going to give you a fast track revision of the chapter Profit Prior to Incorporation. This chapter is, as you know, included in Accounting Intermediate Group 1. Okay. This chapter is, friends, we can say good chapter, having a weightage of around 8 to 10 marks in the examination. The question being asked in the examination almost in all the exams, and it is quite easy, I can say. We will have a fast recap of the chapter. You will get all the concepts very clearly. Okay, fine. Now, when I am talking about the word profit prior to incorporation, it means such a profit which has occurred before incorporation. How it will? Let me just first of all give you an example. Let us say there is a firm of ABC and Associates. There is a partnership firm ABC and Associates which runs its business since last 10 years. The business is going on since last 10 years. Now, there is a new company. There is a new company called A Limited being incorporated. New company is being incorporated to acquire the business of ABC and Associates. Means this new company which will be incorporated only to acquire the business of ABC and Associates. Okay, let us say they made a deal to acquire the business on 1/4/2019. On 1/4/2019 there was a deal between new company called A Limited and ABC and Associates, that A Limited is going to acquire the business of ABC and Associates. Let us say the promoter of this A Limited is, for example, Mr. X. The Mr. X is the promoter of A Limited and he is going to acquire ABC and Associates. The consideration has been fixed, let us say rupees 50 crores. For 50 crore rupees he will purchase this new company. Okay. He has made a deal that from 1st April 2019 I am acquiring your business. From 1st April 2019 I am acquiring your business, but I have to make an incorporation process. Incorporation process will begin now, and let us say incorporation process actually completed on 1st July 2019. Now you can see you made a deal to purchase a business on 1/4/19 and the deal incorporation done on 1st July 19. And now the company closed its books for the first time, let's say on 31st March 2020. So when the financial statements will be prepared for the period 1/4/2019 to 31st March 20 for the first time. This is a first financial statement made by A Limited. But you will say that A Limited has come into existence on which date? It has come into existence on 1st July 19, but it has acquired a business from 1st April 19. So friends, whatever business has been carried from 1st April 2019, it will belong to A Limited. No doubt A Limited was incorporated on 1st July, but business has been acquired from 1st April. This is a specialty you need to remember always. When a business is acquired before incorporation, this concept come into picture. Okay, so when the year will be ended 1st April 19 to 31st March 20, it will be divided in two parts. Prior to incorporation, which we term as a pre-incorporation, and after the incorporation, that we term as a post-incorporation. So pre-incorporation and post-incorporation. Okay, pre-incorporation, I can say the period before incorporation. You have incorporated on 1st July 19, so pre-incorporation period will be 1/4/2019 to 30 June 2019. That's a pre-incorporation period, 3 months. 3 months will be considered as a pre-incorporation. And then post-incorporation period will be from 1st July 19 to 31st March 20. That is 9 months. Okay. So pre-incorporation 1st April to 30 June and post-incorporation 1st July to 31st March. 3 months pre-period, 9 months post-period. Total 12 months of financial statement will be prepared, P&L statement will be prepared, but that profit has to be divided in two parts. The profit or loss relating to pre-incorporation and profit and loss relating to post-incorporation. Why this bifurcation is required? Because the profit relating to pre-incorporation period will be in the nature of capital. That's capital nature. Capital nature profit or loss, that's a capital profit, capital loss, what you term it as, and the profit or loss relating to post incorporation period is considered as a revenue nature. So that's why the bifurcation is needed, friends. Whatever profit or loss belongs to pre-incorporation, that will be considered as a capital nature, and whatever profit or loss belongs to post-incorporation, that will be revenue nature. Fine. And this profit, if there is a profit in pre, it will be transferred to capital reserve, and if there is loss, it will be transferred to goodwill account. Profit transferred to capital reserve, loss debited to goodwill. And revenue nature, profit or loss, whatever it is, it will be carried to balance sheet. Balance sheet, it will be shown in the balance sheet and it will be carried forward. So these are concept of profit prior to incorporation. Okay, now when the question is being asked, they are giving you the details of P&L statement and you need to divide all the incomes and expenses between pre and post, and the difference you are getting as a profit or loss for the pre and post. How to go for it? What are the steps to follow it? Okay, I'm just giving you the steps to solve the question. Steps to find out profit or loss pre and post incorporation. Okay, friends, in the steps, actually the first step we need, that is we want 3 dates. I can say we want 3 dates. That is the first, I want date of takeover of the business. I'm just giving you the very basic steps. Date of takeover. Then I will want date of incorporation of the company. Then I will want date of closing accounts. So these 3 dates you have to accumulate in any question. First of all, the first duty is to accumulate these 3 dates: date of takeover, date of incorporation, and date of closing. Okay, once you acquire this date, from that you have to find out pre-incorporation period and post-incorporation period. Friends, pre-incorporation period and post-incorporation. Pre-incorporation period is going to be from takeover to incorporation, and post incorporation will be from incorporation to closing. This is going to the period, like here to here that's a pre, and here to here it's a post. So that way you will go pre and post. Once you are done with the pre and post period, then you have to find out major step number A, that is time ratio. Find the time ratio. Time ratio is nothing but the ratio between pre and post, pre period and post period. Let us say in our example we see in the pre period was a 3 month and post period was a 9 month. If this is the situation, then ratio is 3:9, and you can further simplify it as a 1:3. So that's how you will find the time ratio. Time ratio is required to allocate the expenses and incomes, that we'll see when it comes to the questions. But this is a time ratio what you are following, pre and post. The ratio between pre period and post period is called the time ratio. Then second step, we need a sales ratio. Sales ratio. Friends, sales ratio is what? Sales ratio is nothing but a ratio between the sales during pre-period sales and post-period sales. Now, pre-period sales and post-period sales, now that depends upon the information given in the question. If they are giving directly, then you can find out the direct ratio. If they are giving in the terms of months, then you need to get the data of months and then you need to accumulate it, and that way you will be able to find out the sales of pre and post. And once you are done with the sales of pre and post, the ratio between two will be a sales ratio. Okay. And then you need, friends, gross profit. You need to find out a gross profit or gross loss, whatever. And to find out a gross profit, it again depends upon the information given in the question. If all the information relating to trading account is given, like they have given opening stock, they have given purchases, they have given sales, they have given closing stock, they have given wages, they have given carriage inward, etc., etc. If all these informations are given, it relates to a trading account. So you will prepare a memorandum trading account. And from memorandum trading account, you will be able to find out gross profit or gross loss. That is the first step you need to consider. GP, you have to find out. Okay, and if they have given directly the COGS, then you can just do it a sales minus COGS. But there are different things depending upon the information given in the question. You will find out GP. Once you are done with the GP, then friends, you will go with P&L account. You will prepare a P&L account with 2 columns. Each side, that is pre and post, because you have to bifurcate all the expenses in pre and post. Now, how will bifurcate the incomes and expenses? The rules for that. Rules for apportioning incomes and expenses to P&L account. How it will go? Okay, fine. First thing, any of the incomes and expenses relating to sales, like we can say variable expenses, all variable expenses will be divided in sales ratio. Like I can say commission, I can say advertisement expense, I can say bad debt, I can say discount allowed. All these are the examples which are relating to sales, which are variable expense. So variable expense or relating to sales will be distributed in sales ratio between pre and post. Second, all the expense which are fixed means not a variable expense, which accrues according to time, will go in the time ratio. Like a salary, which is a fixed expense, rent is a fixed expense, interest is a fixed expense, depreciation fixed expense, insurance fixed expense, there are so many more, etc. So the expense which will not vary according to sales, the expense which will not vary according to sales are considered as a fixed expense, and it will be distributed in time ratio. Okay. Then third, certain items specifically relating to vendor or pre-period will be considered only in pre. It will not be distributed. Like expense relating to partnership firm, the income relating to partnership firm, the income or expense accrued in the pre-period will be considered in pre only. It will not be distributed. Are you getting? The income and expense relating to partnership firm, that is vendor, or which is accrued in the pre-period will be taken only in the pre, it will not be distributed. Okay. And second, same way, items specifically relating to purchasing company, or we can say post period, that will be specifically taken in the post period, only in the post period. It will not be distributed, it will be considered only in the post period because it relates to the post period. So you have to just focus on the time, the date. If certain income or expense relates or accrues in the pre period, consider only in the pre. If it accrues in the post period, consider only in the post. That way it is good. Fine. Okay. And friends, obviously the GP ratio, gross profit has to be distributed in sales ratio. Gross profit will normally be distributed in the sales ratio. And if sales ratio is not given, then you can take a ratio of COGS. COGS ratio can be taken, and if COGS ratio is not given, then you can take certain different bases what they want to give. They'll give in the, or we can just use a time ratio, because time ratio can be assumed to be the sales ratio if nothing is given. So priority given to sales ratio. If no sales ratio, then COGS ratio. If no COGS ratio, then time ratio. Fine. So that way you have to distribute. After distributing all these things, you will close the P&L statement, and the difference will be considered as a profit or loss. So this is how we work on it, and this is how we can calculate the profit and loss. And friends, in addition to that time ratio and sales ratio what we have seen, we are also having some special basis which is to be considered for solving the answer. See, certain special items are there which are considered in special ways. Whatever we seen right now, the time ratio, sales ratio, pre and post and everything was a general rule for all the general items. But for certain special items, there are special rules. Okay, in that the first one is bad debt recovered. Now, bad debt recovered, if you are recovering a bad debt which was already written off in the previous period, so where it should be considered? The answer is that it is to be credited to that period in which it was originally written off as a bad. Okay, let me tell you. In the year 2016, a bad debt was written off worth rupees 5,000, out of which rupees 4,000 could be recovered in 2020. And let us say it was recovered in January 2020, and actually this period falls under post period. If I just give you the simple example, it falls under post, and in 2016 it was written off, then obviously it was a pre, because your 2019-20 year you are talking for, so here it is pre and post if I say you specifically. So in 2016 it was written off, it was obviously pre because there was no companies in corporation. So it was written off in pre and recovered in post. So where it should be considered, where it is to be credited. Friends, what is the rule? It is to be credited in the period in which it was written off. So it will be credited in 2016, not in 2015. Be very clear. So you don't not have to take it in the post, but you have to take it into pre. So that's why when you are making the statement of 1920, you have to credit this bad debt recovered of rupees 4,000 in a pre-period. It's again, I am repeating, that's a very special basis they have given. Bad debt recovery will be credited to the period in which it was written off. So it was written off in pre, that's why it will be shown in the pre column only, it will not be a portion between them. Fine. Second, profit or loss on sale of fixed assets or investment is recorded in the period in which the asset is disposed of. Very simple. When you are selling off the assets and on the sale of asset there is a profit or loss, then that should be recorded in the period in which it is sold actually. If it is sold in pre, then in the pre, if it is sold in post, then post. It means it is not to be apportioned. It is to be directly shown in the period in which it is sold. And third, interest paid to the vendor for late payment of the purchase consideration is divided in the ratio of the time for the period commencing from the date of conversion to the date of actual payment. Okay. Now here actually they are talking for interest on purchase consideration. Interest on purchase consideration. Now interest on purchase consideration, let's go with the example. Date of takeover 1st April 19. Date of incorporation 1st July 19. Okay, and let us say purchase consideration has been paid on 30 September 19, for example. So first of all, okay, let me just change the date. 31st August 19. It has been paid on 31st August 19. You know you have to pay the purchase consideration, but it has been paid on 31st August 19. So first of all, the interest on purchase consideration is calculated for the period starting from date of takeover to the date of payment. Date of takeover to the date of payment. That's a period what is used here for the purpose of this settlement. Okay, so in short, 1st April to 31st August, we can say 5 months. So 5 months interest will be calculated. Let's say purchase consideration was 10 lakhs. Interest percentage was considered as a 12% per annum, and you have to consider for 5 months. So it will be 10 lakhs into 12% into 5 by 12. So how much it will be? Let us calculate. 10 lakhs to 12% into 5 by 12. So it will be 50,000. 50,000 will be total interest of these 5 months. Now how to divide this between pre and post? Friends, in the time period, there is total for the 5 months. Okay, and how much period will fall in the pre actually? You can see this is a pre period, so it will be 3 months. 3 months will go to the pre. So out of 5 months, 3-month period will go to the pre and remaining 2 months will go to post. So this 50,000 of interest will be divided in the period of ratio of 3:2. So interest on purchase consideration, or we can say interest paid to the vendor, it is to be divided in the time ratio. Fine. But what is the period of interest? That is from date of takeover to the date of actual payment, and that period you need to divide between pre and post. Okay. Now next is a tax audit fee. Tax audit fee, if is there, audit fee. Okay, only the audit fee word. Audit fee word. Audit fee can be different types of audit actually. So if it is a tax audit fee, it will be in the sales ratio. If it is a simply audit fee, in the time ratio. If it is a company audit fee, then in the post period only. So you have to just see the word what is written over there. If it is tax audit, sales ratio. If it is only audit fee, time ratio. And if it is company audit fee, then it's in the post period only. So you have to be very clear about what word is being used there, because tax audit relates to the sales ratio, audit fee, simple audit fee is a recurring audit, so it's a time ratio, and the company audit relates to the company, that's why it is in post period only. So this way you need to consider the special basis for allocation. Fine. So you follow the steps and you will be able to solve the answer very easily, friends. Friends, along with that, let us also consider homework question number 10 from the Navkar material. I'm just opening this Navkar material, and in that question number 10 in the homework, I'm just going to give you explanation because there is a good question covering almost all the adjustments. Okay, details. Partners of Maitri agencies decided to convert the partnership into a private limited company called MA Private Limited with effect from 1st January 2002. So the date of takeover vacancy, that is 1st January. The consideration was agreed at 1 crore 17 lakhs based on the firm's balance sheet on 31st December 2001. However, due to some procedural difficulties, the company could be incorporated only on 1st April 2002. Meanwhile, the business was continued on the behalf of the company, and the consideration was settled on that date with the interest at 12% per annum. The same books of accounts were continued by the company, which closed its accounts for the first time on 31st March 2003 and prepared the following P&L accounts. So you can see that date of takeover is the 1st January 2002. Date of incorporation is the 1st April 2002, and date of closing is the 31st March 2003. And accordingly, we'll go further. Okay. Now, if we just check the time ratio and sales ratio, you can see it. Date of takeover 1st January 2002. Date of incorporation 1st April 2002, and date of closing 31st March 2003. Okay, in that, now pre-period it will be 1st January to 31st March, 3 months, and post period will be 1st April to 31st March 2003. That will be 12 months. You can see over there. So pre is a 3 months and post is a 12 months. So accordingly, time ratio is going to be 3:12. Accordingly, it will be 1:4. So 1:4 is a time ratio. Fine. Now P&L details are given. Sales given, COGS given, salaries, depreciation, advertisement, discount, managing director remuneration, miscellaneous office expense, office cum, showroom rent and interest and profit. Company's only borrowing was a loan of 50 lakhs at a 12% per annum to pay the purchase consideration due to the firm and for working capital requirements. The company was able to double the average monthly sales of the firm from 1st April 2002, but the salaries tripled from that date. So what they are saying, average monthly sales was doubled from 1st April 2002. It means in the post period, the sales has got doubled. Okay, so if we just consider accordingly, let us say average monthly sales in a pre-period to be assumed as a 1 rupees. So average monthly sales in post period is going to be double, that is 2 rupees. So total sales in the pre-period is going to be 1 rupees per month into 3 months is equal to 3, and total sales in the post period is going to be 2 rupees into 12 months is equal to 24. So accordingly, sales ratio will be 3:24 is equal to 1:8. Fine, very simple. Okay, and salary was tripled from that date, so that is that we will calculate the salary ratio for that purpose. It had to occupy additional space from 1st July 2002, for which rent was 30,000 per month. So additional space, so additional rent is going to be there, and accordingly for a rent, the adjustment is to be considered. Prepare the statement of apportioning the cost and revenue between the pre and incorporation and post incorporation period and calculation of profits and losses for such a period. So here we need to just bifurcate it. Okay, we have a sales ratio, we have a time ratio, and now we are going to go with the just each and every, I can just give the highlights over there. Okay, friends, first of all, if we just calculate a gross profit, you will just divide it. Gross profit, you will just get a difference, sales minus COGS. So 2 crore 34 lakhs minus 1 crore 63 lakh 80,000. So it will be 70 lakh 20,000. So GP 70 lakh 20,000. And that will be distributed in which ratio, friends? Sales ratio. You know the rule, it is divided in sales ratio. Salaries 1170. Normally, friends, salary is a fixed expense, so it is to be divided in time ratio. But here there is an adjustment. Adjustment is what? That is a salary was tripled from post. So in the post, the salary has been tripled. Okay. Now, if I just do it here the same way what we have done in the sales ratio. Look at this. If average monthly salary in the pre is 1, then average monthly salary in the post is going to be 3 rupees. Same way what we did in the sales. In the pre, 1 rupee salary into 3 months is equal to 3 rupees total salary, and in the post, 3 rupees salary into 12 months is equal to 36. So salary ratio is going to be 3:36, or we can say 1:12. So this is a ratio of salary. It means this salary of 1170 will be divided in the ratio of 1:12. Depreciation, fixed expense, time ratio. Advertisement relating to sales, so sales ratio, it will be divided in sales ratio. Discount allowed relating to sales will be divided in sales ratio. Managing director remuneration, okay, obviously it relates to the company, that's why it is post. It will specifically go to the post, it will not be divided. Miscellaneous office expense, fixed expense, so it will go in the time ratio. Office comes showroom rent 720. Normally, friends, rent is a fixed expense, so it is divided in the time ratio, but here it is an adjustment. Additional rent from 1st July was paid at 30,000 per month. Okay, so rent given in the P&L is 720, and this 720 rent includes additional rent from 1st July 2002 to our period ends on 31st March 2003. So it will be 9 months. into 30,000 per month. So it will be 2,70,000. Okay. So 2,70,000, it relates to specifically a post period, so it will go to the post. Normal rent, if you just remove the additional rent, you will come to the normal rent. So 720 minus 270, 7,20,000 minus 2,70,000, it will be 450. And this 450 is to be divided in the time ratio. So pre and post, it will go in the time ratio. And time ratio is what? 1:4. So it will be 90,000 and 3,60,000. Fine. So 270 as well as 360 both will go to the post. That is 630. So 6,30,000 rent will be shown in the post period and 90,000 will be shown in the pre period. So that's very easy, we have done, friends. So you keep the adjustment of additional rent in mind, friends. Interest 9,51,000, friends. Again, normally interest is a fixed expense, so it goes in the time ratio, but here there is an adjustment. Interest 9,51,000. Okay. Now in the interest, one interest is interest on purchase consideration. You had seen in the first paragraph interest on purchase consideration. Purchase consideration was 1,17 lakhs and it was paid on 1st April 2002 and takeover is the 1st January. So you know the period for interest on purchase consideration is nothing but takeover to payment. So takeover date 1st January, payment date 1st April, so we can say 3 months. So 3 month interest you can calculate 1,17 lakhs into 12% into 3 by 12. 1,17 lakhs, 12%, 3 by 12. So 3,51,000. This 3,51,000 of the interest is on purchase consideration and it is relating to this 3 month, which is our pre period, if you just exactly observe. So this interest will be shown in the pre. See, normally it is divided in the time ratio, but this relates only to the pre period. That's why it will go to the pre. Otherwise, it will be divided in the time ratio as I shown you in the explanation. And second part, that is interest on company's loan. If you remember, you had seen here that a company's borrowing was of 50 lakhs at a 12% per annum to pay the purchase consideration. So company has taken this loan of rupees 50 lakhs at 12%, and this is for full year because it has been taken for payment of purchase consideration, which was paid on 1st April. So 1st April to 31st March. So full period it will be. So 50 lakhs into 12% is a 6 lakh. And this obviously relates to the post period because it has been taken in the post. So that's why it will go to the post. So pre 3,51,000 and post 6 lakhs, in total it makes 9,51,000. This is how we go with bifurcation of interest. Very easy. Fine. Okay, fine. So this way you just elevate the things and close it. Then you will come to the profit or loss in the pre and post. That will be the solution for you. So I hope it's clear to you, friends. This way you can just examine the full chapter and it will be very easy for you to go for. I hope it is clear and it's good chapter for the examination, easy one, and the weightage is also good, around 8 to 10 marks. So all the best.
If you like this video, share it with your friends. Subscribe to our YouTube channel to watch more such videos and learn from our expert faculty members. Press the bell icon to get regular notifications whenever we upload a new video. Download NDI mobile app to get complete CA course online. We value your support. Thank you for watching.